Gotta turn the mic on. That's very important to this. Chat, what's up? How we doing? I wanted to do a different stream than normal, because rarely, almost actually never, can I stream during a Fed decision. So I thought we'd go and do that. Have a little fun with it. I want to build a Bloomberg launch pad for you guys from some of the stuff that I already have up, and we may customize it a bit. That way you guys can go and see market reaction too. I have to be careful though, because some things I have to hide because it's my typical like work. Well, it's my work from home setup, so I need to. Well, I put this here. We'll do the chart grid. We'll put Bloomberg TV up in a corner. We have to double check some stuff because my face is going to be in the way. So I don't want to block too much here. Oh, I guess I could just put myself up in a corner. Can move that up. I can be up here. Maybe. I don't know how seeable is the text on the screen? Oh, it's decently seeable. I guess it could be down here. We can wind this out. I'll bump these up for you guys. And for assets, I want to keep most of these. I'll do SPX fast. And then I can probably do like, I don't know, VIX, because other than that, I got US 10-year treasuries. I've got major FX. We've got some news feeds. That I can have a Bloomberg window too, just to go in. That's what just bring one up. For something if we want that. I can go over here. I can just type in, what's it, WARP for the interest rate for all the expectations, for all the Fed expectations. So you can go and have that up. That just gives your probability of interest rate changes for each Fed meeting. So like what's today? 0% change in interest rates. That means no hike, no cut is expected. Can I have that? I think. Did Bloomberg make the FOMC? So it's got all the different news. It's got different information we can bring up. I'll put this over here that way I can read my Bloomberg chat. Obviously today's meeting you'll go and that'll change. I'll go and kill you for against policy concern. So that will update once the announcement comes in what? Comes out at 2 p.m. So it's in like hour and 10 minutes. Can have that up there. We can have, what is it? SOB. It's that sovereign. Here's all the interest rate curve. I forget if they're dots today or no. I don't think there's dots today. Can't remember if there are or not. Oh, what? 10 years at 435 now? I've been on vacation, so I haven't been paying attention to much. I have not been paying attention to much. Eh. What was this? Was this meeting? I know this was tariff relief. Was this? I forgot what that was. I forget what events that was. I don't know. They all start to blend together after a while. Like, happens all the time. Like, you look at a long enough chart and things just blend together. Like if I pull up yen, just because I trade it all the time, I'll probably be able to bump this. Oh, that was the China tariffs pause. That's what it was. I remember that day because that was tariff pause. That of course was tariff pause. Well, that was Liberation Day. Tariff pause. That was a fucking couple crazy days of trading. Like, unbelievably crazy. Well, let's go and listen to Bloomberg since they're about to go and talk about this. I need to be very careful here in this volume monitor because I have no idea how loud it's going to be.
A little bit. But we don't know how much. That's the open question, given that they have open questions about what's going on with Trump and the tariffs. And then, of course, we have the dot plot. There's some division on Wall Street about whether it'll be 1 or 2 cuts by the end of the year.
Oh, they're doing dots.
As the Fed says, it doesn't really matter. The end of the year is just a construct. It's the long-term path of interest rates that matters to Wall Street.
Dot plot.
And the Fed really doesn't know what that's going to be. So you can take that with kind of a grain of salt. Then, of course, we wrap up with Jay Powell trying to say in as many ways as possible, I don't know.
Yes.
Exactly. And Mike, we were speaking with Lisanne Saunders earlier. She thinks the dot plot will show more dispersion because there's so many possible outcomes depending on what happens next. And it's not just on tariffs, it's on deals, it's on Iran, the Middle East, and so on. Is that what the general consensus is?
I think what you would see is dispersion in the 2026 and beyond dots, not the dots for this year. They're running out of time.
Probably going to look more like, what is this, the longer term?
Officials do that. You won't have any clarity till the fall. There would be only 1 or 2 meetings at which you could do a 2025 cut. But in 2026, we theoretically will know what the budget situation and tax situation is, and we theoretically will know the impact of the tariffs. And so you might get a wider dispersion as different members of the Open Market Committee come to different conclusions about what all that means for the economy.
What's the question that people will most want to ask the Fed chair? I mean, there are so many sort of peripheral things that people will be asking about, I'm sure, including the most recent remarks from the president about Fed Chair Powell, and also, you know, the possibility for disruption to energy and so on from the Middle East crisis. But, you know, beyond the peripheral things, what will he be asked about?
Well, I'm sure nobody is going to ask him if he's stupid, like the president said. But he may get some questions, certainly, about his political future and whether he'll stay on after he's replaced as chair. I think the main question that gets asked today in probably different ways is, when does the Fed think it will know enough that it could make a decision on whether to raise or lower interest rates? And that's a hard one to answer because so far, coming into this, we have seen inflation relatively tame. We haven't seen a lot of tariff price pressures, but Fed officials think it's coming. So when does that show up?
You know, typically central bankers don't talk about the currency. I'm sure Fed Chair Jerome Powell
He's
won't
gonna
either,
not say a damn thing about it.
the dollar at least, right?
Well, he has been asked in the past, and as you say, he dodges that question.
Why would he say anything
it's
about it?
basically
It's not the Fed's purview
the
to go and
Fed
do
looks
that.
at the impact that has on the overall economy if the dollar weakens, and that
why would he say
raises
anything?
Import prices. Then that's an inflation danger.
He shouldn't say
but,
anything.
We have to remember that the dollar is still, even though it's been falling, still at a pretty high historical level. So it isn't clear that that's making a big difference right now anyway.
Will he say that there are cracks in the labour market, or have the data backed that up recently?
The data are very mixed on that. The ISM numbers have shown that the manufacturers and to some extent service industry providers
we're at a 3-year low
are
on the dollar.
planning fewer hires. They think they'll have slightly smaller workforces. CEO survey out today suggests the same. But when you look at jobless claims, they've jumped up probably because school's ending and it's a kind of a weird time. But no real cracks yet. It's another thing that's on the horizon.
All right, Michael McKee will be.
Yes. I mean, the Fed's not going to do anything today, but it'll be interesting to go and hear what the press conference has. More than anything. That's more so what I'm paying attention to. Dot plot to me is always like a Rorschach test. Like, you see what you want to see. There's nothing more, nothing else to it. I mean, if there's a large dispersion in the dot plot, all that means is that there's uncertainty. I mean, market doesn't think that they're going to go and hike or cut. That's why for Fed interest rate swaps, there is nothing priced in. They think we cut in. They think that there's an even split chance for September and October, which would probably be my guess as to if they're going to do something. Probably be September. It all depends on the budget debate, but I mean, a lot of it's very up in the air. You have a number of things that could happen. I mean, people are forgetting that the tariff pause comes undone here in, 3 weeks? 1, 2, 3, yep. 3 weeks. So, I mean, and that could come undone, that could not come undone. So how do you really go and give any type of forward guidance in the future? You really can't. Especially since it's on, off, on, off, on, off, on, off. I believe it is, August 9th? When the China tariff pause comes off, so that's probably why it's September, October, because you get a fault from that. If the tariff pause does come undone on July 9th, and they stay unpaused, then cutting in July serves no purpose because you don't get any data whatsoever to go and determine what the path of interest rates should be, or like the economic impact of tariffs. The real economic impact on tariff, not the theoretical. So there's no reason not to wait. .5% seems pretty reasonable. I mean, that's also what 10 years anchoring on, and all other short-term rates. You have a positive sloping yield curve, like in general, like it's a decent place to be. All unemployment data has been pretty decent. So really, there's not much that the Fed can really do. They have to take a wait-and-see approach. It's very hard to go and just move off of variables that you have no control over and you don't know what the predictive outcomes are. It'd probably be it'd be a huge tactical mistake to cut. Hiking is out of the question. I mean, their main worry is inflation. So you do gotta wait and see, but what is... Market thinks by the January Fed meeting that there has been 2.25 cuts. Two and a quarter cuts. That doesn't make any sense based on the delta of the implied interest rate. What, just 25 bit cuts? Yeah, okay. But that's just what the market's thinking. Now, one thing that I don't have for my Bloomberg is live equity data. So, sorry about that. But I don't trade equities, so it's really a cost that I don't really care about. Well, equities off to a mixed. It's like a mixed day. I'd say flat day. With dollar off for the most part. I want to look at Swiss. I'm shocked that the S&P hasn't intervened when it was down here. Shocked. Oh, Chad, we got a bit of a banger right here. Banger song.
Just wanna pack up my things and go. Just wanna be free, just wanna zone. Just wanna flow, just wanna hang with the gang, but sometimes chill on my own. Just wanna do me, just wanna doze.
Chat, what are we thinking for the rate decision? Chat, what are we thinking? Chat, what are we thinking? No move. I guess this could be all about the press statement, really. Well, the Q&A too. It's gonna be all about the presser. It's gonna be all about the presser, which is typically what I pay attention to more than any of the written statements. The written statements, everyone does the same thing. You take the written statement, and you compare it to the previous one in Word, and you look at for like doc changes. And then it's like they removed one phrase, but they didn't remove another phrase. It's all very very much commoditized now, and you don't really get any big changes like doc to doc. And people always obsess over, oh, what's this change of phrase you mean? And it's like from like few to some, and it's like it really just doesn't have that much meaning into it time by time. It really doesn't. But everyone obsesses over it all the same. I am surprised at how weak the yen is today. I mean, how strong the yen is today. Actually, more so, I'm more interested in how strong the Aussie is today. Let's look at a bigger chart. Oh man, I remember this day. I remember this time. That was disgusting. It's just been grinding higher. Where are we at? Blah, 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 track. Okay. Back to where it was early deck of last year. So it's been a steady grind higher. I mean, it's going to react pretty much universally to US-China tariff talks. For those of you wondering why you see the same headlines on these, occasionally it's because they do have two different filters on them. One's just based on the currency sheet, one's based on currency markets, first word FX. I think there's like a couple other filters on this one. Apple equity is just it's just a default that Bloomberg does on them. And so this one has like a slightly different things than this, but there will be overlap. I think one is faster than the other. I think this one's faster. So I'll put it on top. It's like at work, I have this one, and I have like one that's like it's slimmed down even more so that there's less, like, it's from like more important things. I'll make these even bigger. Boom. Because for like right now, the news feeds probably could be more important than anything else. I think it's fun that my camera cuts off some of the TV. You're just gonna go and see here pretty soon Jay Powell talking. It'll be Powell talking. We'll probably listen to the Bloomberg discussion beforehand, which will be in like 20-ish minutes. Because depending on the guest, it's always it's interesting. Also, it's Tom Keene, Lisa Bremwitz, and John Farrow, the best trio in all financial news. Chat, do we have any thoughts going into the meeting? What do you guys think? What do you think Jay Powell's gonna say? I think risk, moderate risk, is gonna definitely be in there. Wait and see approach will probably be mentioned. Is there a Fed bingo card on Twitter? Aha. That's not a very good one from... I found a previous one that I had in like one of my chats. But it's not a very good one. Chat, how are we today on this beautiful Wednesday? Vic's starting to perk up a bit just because most likely people have no idea what Powell's going to say, so they want to hedge their S&P. That's something people like are super moronic about when it comes to the VIX, is that it really is just S&P vol at the end of the day. And it can be used as a cheap hedge to go and hedge downside. Predominantly is how equity managers use it. People who typically talk about the VIX have absolutely no idea what they're talking about when it comes to vol term structures. Speaking of vol term structures, something I haven't looked at in a while. Is the Swiss smile. Oh damn, it still is pretty. I hate how it keeps defaulting to these time frames. I do not want these time frames. I want 3 months apart. So I want, what is it? There we go. Did I do the April correct? Or is this a holiday? Oh, it was Good Friday. It was a holiday. Damn, it's still steep. Oh, it's flattened out a bit. It's not nearly as steep as it was during the tariff situation. Even less steep than it was. I mean, not as steep as May either. Let's look at the 3 month. It's come down a decent amount. Which leads me to think, yep, riskies have come off quite a bit. Cause 25 delta put would be right here on April 17th, which would be here in May. What is that, May 19th? Would be here. So they have weakened a lot. Starting to slowly get to more balance towards the call side. Which is absolutely where they should have been. You should have been fading this the entire time. But the riskies are still pretty high. Still decently high. But if we look at to our previous date, what was it? Well, we call it April 17th and May 19th. Too many lines. There we go. Let's just go to the put side. Yeah, your 1 month put. Essentially what we'll call it an easy 3 vols higher back in April. Four vols high. May this time last month was still a vol higher. At the monies were fucking crazy. See, what you should have been doing here was selling all this part of the curve, which is why you had all that steepness I was showing you in the smile. Should have been selling front month fall, and still you could have been long 1 month fall, even though it has dropped off by what is that? 1.2 vols. You would have still made by being able to short. You're doing a pair trade essentially. You're selling 1 month, buying 1 year. Could have even made it a tighter spread. You could have been doing 1 month versus 6 month. And what there you would have lost point, we'll call it point 1.2 again, but you would have made 3 vols essentially. It's a great trade. Phenomenal trade, in fact. I only go up to 2 years in my vol curves. Not 2YT. It's gonna freak out. Oh, no. Another way that you can go and look at this too. So it's doing the same thing. Oh, there it is. That's the money ball. That's the settings. I don't want to go all the way up to 10 years. I hate that it defaults to 10 years. I have my custom curves. I guess I could go and do my G library. My custom curves don't have that in there. What the fuck? I know they don't. But whatever, you can go and see. Oh, I hate time frames. But I was essentially, what those would go and do is show you the same thing. There's just changes in the vol curve essentially, and where the market's marking them. Chat, any questions, any comments that we want to talk about before we start getting serious here in the next 30 minutes? Next 30 minutes to 2 hours, I guess. Questions, comments. I do have YouTube chat enabled, yeah? Oh, I do. So yes, YouTube chat, you too can listen in. Ah, Jesus Christ. Oh, that's right. They had the SEP today. These, what is it? The Statement on Economic Projections, I believe it's called. So that's their estimates for the, that's the, summary of economic projections. That means that the Fed essentially goes and tells us what they think is going to happen. That's where you gain all the little nuggets about where they think interest rates are going, where they think the global economy, well, the U.S. economy is going. Essentially gives you a pathway of what their base case is. In this case for September. Is it for September? No, it's also the dots. So it's like 2026 and beyond. Who is this fucking moron? Powell should lower rates immediately or resign. What a fucking moron. What an absolute moron. The last thing the Fed should be doing is changing rates right before they have no idea what's going to happen. So chat, the way that this works, if you guys are new to FOMC days, is here in about 30 minutes, the press release gets put out And then after that, I think it's, 30 minutes afterwards, 2:30? Then Fed Chair Powell comes out to then go and deliver remarks, aka Q&A, where he goes and gives a brief statement and then does Q&A with reporters. And Q&A is typically the most valuable part of all this because you can go and get a lot more detailed questions based on the Fed press release and any other information they give. Like in this case, it'll be the statement on economic projections, or the summary of economic projections, aka the dot plot. So you can go and hear some questions about that. The market currently thinks, based on the Fed prediction markets, not the prediction markets, but the swap rates, I think that there will be no hikes for this Fed announcement. And with all that being said, I'll turn off the music and we're going to listen in on Bloomberg because I really like this segment. I really like when they do these.
Fed rate decision and Chair Powell news conference.
Let me know if volume's
Tom
good.
Keene, I'm Lisa Abramowitz. Someone is missing. Tom, I believe.
Missing. I just got a message from the Bank d'Italia, and he's 24 miles south of one of their branches. I think it's an island.
Yeah, well, somewhere beautiful, and unfortunately, he is missing the most riveting Fed meeting since the last one.
Certainly most political.
And
My
the most
word, the comments this morning.
About it from President Trump coming out and saying he should be the head of the Federal Reserve. Honestly, quite a time for him to be coming out.
It's going to be a long show, the
your
press
browser's
conference. He's got to rebut the comments today.
I was just making sure sound was good.
There's also this question of how much uncertainty can you possibly have at a time where not only do you have tariffs, do you have changes in policies in Washington, D.C., but now you have what's going on with Iran and Israel threatening to disrupt oil supplies
Sorry
at a
about that.
time
You guys got
when that
double
will
audio
only
for that.
add to some of the inflationary questions.
And
that is my bad.
Over $80. They're not there yet, but over $80 a barrel, things change.
Yeah, and this is why we're watching the statement of economic projections as well as what we might end up getting from the forecasts in the dot plot. Right now in markets, you could see a bit of calm. You've got equities that are rallying despite some of that uncertainty. Just to give you a perspective, since the last meeting on May 7th, S&P is up almost 7%. When you take a look at yields, they are up materially, about 10 basis points on the 10-year, up from on May 7th, the last time the Fed met, 4.36%. And crude lower, but still up materially since that last meeting. Coming up shortly, J.P. Morgan's Bob Michael, Kathy Jones of Charles Schwab, and Greg Peters of PGIM will be taking us up to the Fed rate decision
All
at 2
very
p.m.
good
We'll get immediate reaction
people to have
from
in
former
down
Fed
there.
Vice Chair Rich Clarida, Diane
VIX is
Swalwell,
starting to rise a little bit as we get closer to the event, and alongside with equity starting to turn negative and yields starting to spike a little bit higher.
Subhadra Rajappa of SocGen and BlackRock's Jeff Rosenberg. Joining us now, we are so pleased to say, is J.P. Morgan's Bob Michael. This is actually a big deal because they're going to release their quarterly summary of economic projections at a time where things haven't exactly gotten clearer.
Yeah, I don't think this is a boring Fed meeting. I think this is a historic Fed meeting. You've got the Fed dealing with a lot of things. Tariff policy could be something we haven't seen in a century. You could have a potential major conflict in the Middle East. And of course, when you look at the One Big Beautiful Bill Act, if that passes, you've got the extension of one of the biggest tax breaks in history.
Indeed.
If it doesn't, you're going to have one of the biggest tax hikes in history. How does the Fed bring all of this together?
The question really will ultimately be, what is the reaction function? Where are they placing
Which is
emphasis
exactly
right
why
now?
the Fed should
data
not
that does
raise
appear to be
rates.
weakening.
I mean,
we
cut
are
rates.
seeing a shift upward in the jobless claims over a 4-week moving period. You are seeing the economic surprise index roll over into negative territory, or on the potential for inflation from oil, from tariffs, from some of these policies that they don't really want to get involved with commenting on.
Well, that's why the summary of economic projections is going to be so critical this time. The last ones were in the March meeting. Of course, you've had Liberation Day, you've had the One Big Beautiful Bill Act, and now you've got Israel, Iran. So all of that, they have to weigh into that. We expect, of course, they've got to
This is
raise
the
their
economic surprise
expectation of
index that they're talking
inflation.
about.
So core personal consumption expenditures, we expect them to go up from 2.8 to 3.2.
Been rolling over quite aggressively
And they're going
recently.
to bring down growth, probably from 1.7% GDP to 1.4%, and you'll probably see a tick up in unemployment from 4.4 to 4.5. and probably just one rate cut this year, not two.
From where you sit, is the job market cracked? I mean, 245,000 for
One rate cut
average
indeed.
weekly claims. I would say the majority of people say not yet, but how's our labor market?
It's on the knife's edge, and what you see in the weekly claims data is that businesses are neither hiring nor firing. They're frozen. And you see that with continuing claims continuing to go up. That tells you that if you've been laid off, you can't find a job.
I'm not going to let this go, and I like that we have 3 bond people up top. I think the bond market's speaking right now versus the equity market. I want to look at the 10-year real yield. I'll let you pick the duration. But what's amazing to me is it's still range bound. Do you predict that the inflation-adjusted yield will break down to a new lower disinflationary, slower, sluggish tendency, or can it break up with all the geopolitics we've got?
It's probably likely to break up. I think there will be an expectation that as all these different policies take shape and are deployed, that's going to create a lot of anxiety and volatility in the market. Break-even spreads will have to accommodate for that. So
is it rude to ask for a level at this time of our Fed show? Let's ask for a level. 203. Can you give me a number to 2 decimal points up? 220?
Yeah, I think you're looking close to 2.25%.
Farron would never let me do that.
Well, John will be back next Fed meeting, so don't get too excited. There is this question, though, and you raise it in some of your expectation, and this is the baseline expectation that they are going to raise their inflation expectation, downgrade their growth, and also reduce the number of rate cuts that they have. Doesn't that imply that they see the potential inflationary shock as being something more than transitory? I know that T word is somewhat contentious. At the same time, people are pointing to that weakness that Tom was talking about in the labor market and saying, why not weigh in on that if you think that this is actually going to be a passing trend?
I think what it tells you is they're in a pretty good spot right now. Nothing's really broken. Yeah, everything could move materially in one direction or another. So why shift things in anticipation before you know what the actual policies look like?
I agree.
And the impact to the economy.
Meanwhile,
why make a shift when you can sit and wait?
At the top, there has been this drumbeat from the White House, and we only got that again this morning when President Trump came out and said the Fed should really be about 2.5 points lower, saying that they should reduce the rates that much, and then saying, I would be a really good Fed chair, and he'll be out the second that his term is up. At what point do you think that really starts to color the press conference in terms of how the Fed wants to color their decision, even if it is based purely on the economic data?
Yeah,
Jay Powell's going to get the question about it. He's going to go and say, I'm not going to comment.
Down to 1 7/8%.
He did meet with the president, so he may get asked about that.
Or go up to about 5%, maybe higher. We have history for that. 1992 to 1994, the spread from Fed funds to the 10-year was 300 to 400 basis points. And that was another period where the markets felt the Fed was overstimulating. He's going to get asked a lot of questions about that. Why not?
Why shouldn't he answer them? We have a template of McChesney Martin in 1951. We have the Vietnam War, LBJ, really unhappy. Maybe it was Nixon, I can't remember right now. What is this silence that we get from Powell? He should make some form of defense of the institution today, shouldn't he?
I'm sure he will. I'm sure he'll defend the integrity with which they look at inputs into their decision-making process and the summary of economic projections. In the past, he has admitted that there are wide dispersions of time. Not everyone is in agreement. We think this time there will be unanimous on not changing rates, but I think he will defend the institution.
Let's say the Fed were to cut rates, not by necessarily 2.5 percentage points, by let's say a percentage point. How much would long-term yields rise based on the current expectation of an elevated trend of inflation for a longer period of time?
Probably not a lot. I think the market is expecting about 100 basis points in rate cuts over the next year. I think everyone has moved to a December rate cut and 3 more early part of next year. So that's already effectively in the market. It would be interesting to see what that does to the 10-year. Does it bring it down a little bit? And does that create a more positive dynamic for the housing market? That's the one thing that worries us the most.
It is, okay.
When you look at the housing data today, it's at a cycle low.
Yeah, and that was something that we saw in economic data that we got earlier this morning, and we've been getting consistently. I am just wondering how much that forecast for front-loaded or back-loaded rate cuts next year stems from the fact that we're going to have a different Fed chair, who potentially will be a little bit more dovish.
Yeah, that's the case. Look, Fed officials are political appointees. They're not voted in, so they're going to be appointed based on their views and beliefs and what the administration wants to endorse.
So did you hear that, Tom? He said that this is actually going to be a riveting meeting, so we should all be very
agree.
clear.
We should all sharpen our pencils.
Did I think it was a snooze fest? Maybe, but we have migrated from that. At least I think this is important to state. We're fighting 2.5 wars. We're fighting Ukraine. We're fighting from Israel to Persia, and we're fighting, with great respect, half a war in Gaza, I guess. So it's 2.5, if not 3 wars. When did we have a Fed meeting with 3 fronts, ever?
Well, with 3 fronts on one side and then a home front with a question of policy. And Bob kept talking about the bill that may or may not get passed, with the CBO putting out that it would increase the deficit some $2.8 trillion over the next 10 years. How much does that factor into a Federal Reserve who is being accused of raising the costs for this government by the president? This is something that he's going to have to discuss today. I'm sure he'll get asked about it. Bob Michael of JP Morgan is sticking with us, which we are so pleased about. Coming up, we've got Kathy Jones of Charles Schwab and Greg Peters of PGIM as we count you down to that Federal Reserve decision. This is Bloomberg.
Chad, any thoughts on what Mr. Michael said? I mean, I happen to agree with most of what they went and discussed, which is, why would the Fed go and make a move now when a lot of risk on the horizon that they can react to at a later point in time? Especially if they react too early, then everyone's going to go and say, so what are you going to miss? It'll be interesting. I mean, we're going to go and get the press release here in 15 minutes. And then, in less than, in 45 minutes, we then go and get the press conference. So it shall be interesting. It shall be very, very interesting. Equities make a small bounce right before the press release. We've got yields still holding steady, and the VIX, of course, taking a turn lower. U.S. dollar still is strengthening a tiny bit, I'd go and say.
Not do anything.
The Fed wants to be, quote, late to the game.
It makes sense for them to be on hold. They will continue to sit on their hands.
They're going to upgrade inflation. They're going to downgrade growth.
They'll continue to say we're being patient.
The FOMC is prioritizing inflation over the labor market.
Powell will probably say that he will continue to wait for clarity.
You probably are going to get a lot more wait and see, a lot more to learn.
The Fed is going to wait and wait and wait.
Such an intro. The riveting Fed Decides, the countdown to the Fed Decides on Bloomberg TV and radio is right now. I'm Lisa Abramowitz alongside Tom Keene. Jonathan Ferro is on a well-deserved week off. I will just say right now, markets kind of range-bound as they assess all the potential risks in markets. They've come a long way, though, since the last Fed meeting on May 7th. You can see the S&P is almost 7% higher. Now it's up by almost 0.3%. Across the board, we have seen gains in the equity indexes, in part because of this. You have seen this expectation with yields higher across the board since May 7th, but not running away. And that has been one of the concerns. Do you end up with this yield premium that really becomes pernicious? Right now, not so much, still up about 10 basis points, but the 10-year yield, 4.37%, I should say 10 basis points from the last Fed meeting. But oil, Tom, and this is, I think, what we're watching most closely. Oil prices materially higher since the last Fed meeting, up some 28% on the heels of what's going on.
There's a rule, and Bob will remember this from LIBOR OIS in 2007. You go 4 standard deviations. It matters. 2 days ago, Brent crude went 4 standard deviations within a very tight range. I don't want to say a lot about it other than we haven't hit 80 yet. People are modeling out hundreds. I don't have the name. I can't remember, but somebody modeled out a 1.5% hit to GDP with $100 oil. I don't want to be inflammatory on that other than it's moving up. It's part of the mix. You know, I like the headline here moments ago. This, you know, Powell could say this today on cutting rates. I may do it. I may not do it. We may get that from Jerome Powell.
I'm guessing that that's not going to be the case. Joining us right now,
it may be the case.
Kathy Jones of Charles Schwab, who I'm sure agrees with me, and Bob Michael of J.P. Morgan is still with us. Kathy, thank you so much for being with us. How much is this Fed going to have to respond to what's going on with respect to oil prices, in addition to what we have already learned, both on tariffs or not, as well as the budget?
It's just another layer for the Fed. I mean, it's just like this layer cake that you just keep adding on one risk, one policy issue after another. So on top of tariffs, on top of the budget bill, on top of the multiple wars, now we're going to have energy prices as an input. And I think that this makes it even more complicated, and it was already really complicated to start with.
And part of this is the guessing of GDP. We were talking to Bob about it before, and whether it's a nominal GDP mystery of what inflation's going to do, or even real GDP. Do you get a sense that there's a real dispersion of wonderment about where real GDP is the end of the year, or dare I say out 12 months to Q2? It's next year's 2026, is that right?
You got this.
Nailed it.
Oh, we got the year now. I don't know that there's a lot of dispersion on expectations yet. I think we haven't even gotten to the end of the 90-day pause on tariffs, so we don't even know what the effective tariff rate is going to be longer term. So I think a lot of people are still modeling kind of a muddle along, not bad kind of GDP growth because consumers have hung in there. But I think as we get over the next couple of months, what we're probably going to find out is how's the labor market holding up, how's consumer spending therefore holding up, and what do all these policy changes have? What impact are they going to have?
At a certain point, though, and I got to say, Bob, we do have some certainty. And this is something that I think people should recognize, that tariffs are going to be on, that you do have an economy, that, yes, it is weakening, but it's not falling off a cliff. I mean, don't we have that base case, and then they have to give us some sort of scenario analysis for what they do with some kind of stagflationary type of situation?
And you've got the CBO out there scoring what the revenue from tariffs is, which, by the way, magically exactly matches what the One Big Beautiful Bill Act will spend over the next 10 years. So, yeah, I think it's incumbent on the Fed to give us some answers this time. They have enough information. They can talk about what they use to model and then what the tail scenarios are.
We thank Neil Dutta for listening today with RenMac. Thank you for the note.
Make sure you'll get
Neil
some more
just
answers
says,
from
look,
the Fed.
Consensus always is behind. They'll pencil in whatever, and they'll be there after it happens. To me, what's missing here is the drama of the president, 2%. He wants 200 basis point drop. The drama of President Trump, you know, I can do it down 100 beeps, down 200 beeps. What's wrong with a 25 beep cut? Multifamily housing's down 23% or something. The housing market's flat. Jobs are getting tense. Just go down 25 beeps and say, we'll look at it next meeting. Why can't they?
The issue is they look a little.
They could, but there's all the uncertainty.
It makes them look a little
what
too
these
apprehensive.
Big policies will look like. What will the bill going through Congress eventually look like? Where will tariffs settle? What will happen in the Middle East? They need a few more answers. And right now, everything looks okay. Most of the time, we would look at where the labor market is, where inflation is, where growth is, and say, we would take it 9 out of 10 times. So I think they're smart to just sit here, tell us that they believe policy rates are slightly restrictive, and then wait for an opportunity to bring them down.
Kathy, do you think they should weigh in more on the hawkish or the dovish side, considering the weakness that we're seeing in the economy in tandem with some of the inflation fears that have really abetted quite a bit?
Yeah, I think the problem with being too dovish right now is that there's a lag time between tariffs and when it might hit the price level. There's a lag time in so many of these things. The energy prices be a lag time. And they are further from their target on inflation than they are from their mandate on unemployment. So if you remember last time, Powell said, we look at how far we are away from our targets and we set policy based on that. Well, they're further away on inflation than they are on unemployment. So that would argue not to be too dovish at this stage of the game.
Which raises the question, and this is something that John would be saying if he were here. He'd say sometimes you can learn more about how the market reacts than even the news itself. Joining us now is Greg Peters of PGIM. Greg, from that perspective, how much are you expecting the market to really want to hear a dovish message versus a more hawkish one when you take a look at longer-term bond yields that are a little bit more controlled than they have been, but still nudgy?
Yeah, I mean, the bond market's been in a very volatile range for several years now. The market is clearly leaning more dovish. I think they're going to be sorely disappointed. I think the Fed is focused on inflation, and the market is, focused more on the growth side. What you're also seeing is kind of forward path of rates is baking in this new Fed regime, whatever that means. So, what does the Fed look like post Powell? And so the market is really skewed one-sided around rate cuts and the amount of rate cuts as you go out the curve. And I'm not sure the inflation dynamics or even the growth dynamics support that.
What do you see in the comparison of nominal to real yields in the bond market, Greg, right now? What's the dynamic just the last couple of days between a nominal, full faith and credit and the real yield?
Yeah, I mean, you look at real yields, they're, just call it, above 2%. That's, pretty substantial. I think that's, on the higher, end of the range. I would expect that to come down, but you could interpret that, the beautiful thing about yield and real yield, you can interpret that, a couple different ways, right? It could be a strong macro growth story, or there could be something more nefarious. So I think that, real yields are a little too high, but not dramatically so.
Greg, what Bob Michel was talking about was that this is a Fed that's going to have to give some answers. They're going to have to answer how the reaction function really does change as their dual mandate comes into conflict. And we do see something more akin to the stagflationary picture that the summary of economic projections is likely to show. What would you like to hear? And what would your question be if you were in that meeting talking to Fed Chair Powell?
Yeah, well, I think Bob's going to be severely disappointed because I don't think you're going to get answers. But I think, I think they're going to dance around, in the environment. But, quite frankly, I would ask the employment question. I think this economy and even inflation hinges around employment. You have seen some weakening. There's some seasonal adjustment factors there as well. But really trying to hone in on how important is the employment picture and what are the targets that you're looking at, whether it's quit rates, whether it's, any other measure they want to put forth. But I think it's all about labor, and we're getting lost in kind of the other narratives.
I think housing as well. Schwab network. We're talking a big fancy bank here, boutique fancy people over in Jersey City at Prudential. What do you see in the real world of Charles Schwab from your clients?
I think investors certainly retail investors are very nervous.
Any retail investors out there?
All these policies very uncertain. It's been volatile. And I think they're very nervous, but what they're doing, broadly speaking, is keeping some duration, but not too much. So we've been advocating kind of a middle ground intermediate term duration. They're finding the yields are relatively attractive. If you go into investment grade corporates or municipal bonds have been very attractive. Yeah. They're finding a spot where they feel secure because they are a bit nervous about the equity.
5-minute warning, chat, on the press release.
Its record high of 2 days ago. I mean, I find retail here to be just absolutely fascinating. Of the nervous and OMG, what's going to happen? Long term has become 2-year paper in a stock market that's up near record highs.
I'm still trying to wrap my head around your croissant that's down $1.20 since a week ago. I mean, go figure. It sounds like a bad business practice. I am curious, though, about how much they see the risk as inflation versus weaker growth. And that really is going to be the quagmire for the Fed.
Yeah, for the Fed, I think that is the what comes first, what's the order of magnitude of either one. That's what they're trying to assess, and that's why the consensus is they're on hold, because these things are still playing out. We still don't even have all the policies. It still has to finalize some of these policies that are conflicting in some ways. You know, they're gonna slow growth and they're gonna raise inflation, but then on the 6 months from now could go the other way. That's a really tough environment to set a policy.
You know, Bob, I find it interesting because you've come on the show, and earlier in the year you talked about a sub 3%.
5-minute warning, 4-minute warning, everybody, until the press release.
That's obviously changed, and you have changed some of your outlook. But I wonder if it's based on some of the Sell America trade, if it's based on inflation, or if it's based on something related to just supply and demand having to do with yield term premium based on Washington, D.C. and that big, beautiful bill.
Well, I think there are a couple of things. One, tariff policy is far more aggressive than we originally thought it would be, and it's going to settle in above levels we had expected. The One Big Beautiful Bill Act, that came out to be much higher in terms of incremental spending than we had also assumed.
Equities starting to climb here right before the meeting.
Just made you pause and say, what's the Fed going to do? They're probably going to hold off. Greg mentioned that the rates market has been relatively volatile. We're taking the other side of it.
Dollar rising a little bit as well.
It's remarkable to us how stable it's been. I'm surprised the 10-year Treasury isn't 5%. Fed funds is 4 3/8. It's been.
Chat, I'm gonna go to the bathroom real quick before the policy decision comes out.
Half of the year go by, and one after another rate cut that was expected pulled off the board. So that's already happened, and the market's on board with a rate cut in December. You could take that off the board. I don't care. We're 4 3/8%. We've been there for a long time, but we see it because we have meetings every day with people looking to get into the bond market. I've not had a single meeting this year with anyone saying, oh, I've got to get out of the bond market. When do I get out? How do I get out? It's all about, is this the time to get in? Where should I go? About de-dollarization.
Greg, just quickly, a final word from you.
Here we go, Chad.
No, I think of all the things that are going on, I think this Fed meeting is probably the least important, right? They are just reacting to, all the events that are unfolding that we're discussing and the uncertainty. So I think definitionally you'll see a Fed behind the curve. And I think there's no way to get around that fundamental fact.
Kathy Jones, Greg Peters, to both of you, thank you so much. This is the countdown to the Fed Decides on Bloomberg TV and radio. We are just about a minute and 10 seconds away from that Fed decision.
Any dissent?
I don't know. I
don't think so.
I think maybe.
Today, I don't. If I was dissenting against Jerome Powell today, he's under fire. I mean, they're coming out of the trenches after him.
And there's no reason for them to say that they should cut rates. The dissent will be expressed maybe in the dots, because we are going to be getting the dot plot, which I know you all love very much. All of a sudden, if you start to have people pulling dots off the base in terms of how many rate cuts this year and only one getting gamed out in those dots, how much does that really put the fire on Jay Powell?
We need James Bullard to come back and give us that lowball dot.
Yeah, well, he actually was thinking, he took the other side of that. We actually caught up with him earlier today, and he said that this is a Fed that should recognize more greatly the weakness in the U.S. economy, as evidenced by the downside surprises, as well as what we have seen with respect to the labor market and the housing market. Neil Dutta, that's just for you. Heading into that meeting, into that decision.
All right, medium dot forecast still shows 50 basis of rate cuts in 2025. Wow. Fed benchmark remains on hold, meaning we are in 4.25%. hold. The Fed holds rates.
Changes to the statement, no change to the dot plot.
No change to the dot plot. Wow.
Changes to the outlook. Fed officials still forecasting 2 rate moves by the end of this year. As
the dollar is getting crushed at the moment as rates crater lower.
2 more than in March. 4 see just 1
equities
cut.
higher.
They do see 1 less cut than they had for next year. The biggest change to this statement is the balance of risks. Uncertainty about the economic outlook has diminished, it says, but remains elevated.
Yep.
In May, the committee said uncertainty had increased further and that the risks of higher unemployment and higher inflation have risen, a phrase that is dropped from the statement today. They also changed their labor market outlook to say unemployment remains low rather than May's stabilized at a low level in recent months.
Got it.
Conditions remain solid, they say. The forecast sees only a slight increase in unemployment by the end of this year to 4.5% from their March forecast of 4.4%. Unemployment will remain at 4.5% next year. Inflation, however, is forecast to rise significantly. It will end this year at 3%, up from a 2.8% projection in March. Headline inflation was 2.1% last month. Core inflation will be 3.1% this year, up from a March forecast of 2.8%. Growth should slow, rising 1.4% this year. That is down from a projection of 1.7% in the March SEP. The neutral rate remains at 3%, though some members think it may fall in 2026. The decision was unanimous, so the bottom line basically is with fiscal policy, tariffs, and taxes still undecided, there is still too much uncertainty for officials to give a clear answer as to the path of how monetary policy will respond.
Mike, thank you so much. Great work as always. That's Michael McKee, our correspondent for economics. We're looking right now at a reaction market.
Equity is mostly higher off that reaction with the dollar weakening. We also have yields lowering as well. VIX goes and gets punished. Essentially, benchmark rates hold steady, lowers GDP estimates by a little bit, and raises inflation estimates a little bit higher. That's probably due to the uncertainty over tariffs. And then the median dot plot still shows 50 bips of a cut in 2025 with a dot higher in 2026. The 2026 dot goes higher by 25 basis points. Essentially, it's going to be a short-lived couple rate cuts and then going to stable back in, probably to go and blunt whatever tariff bumpiness comes into play.
It was a close call. I actually thought they would get rid of one of those cuts. So I think you read it well. It is a dovish lean from the committee. I do note that apparently
we will be getting Fed Chairman Powell's statement here in about 27 minutes with Q&A to follow.
In March.
I look, Richard Clare, to say Jeffrey Frankel at Harvard years ago saying we've got to go beyond the dual mandate. Within the scope and scale of your economics and what you did at the Fed, line up the priority of those things: employment, inflation, economic growth, or the side distractions we have from the president. Line up those distractions forward for Jerome Powell.
It's got to be inflation,
well,
then
I think right now, look, the economy's in a pretty good place. The labor market is at or close to full employment. Inflation has been coming down this year. I think right now the third factor is the uncertainty about the tariffs, probably also on fiscal. I do think that if we had not had the overshoot in inflation in the last several years, then we would probably already signaling a rate cut at this meeting. So I think there is some history dependence here as well, Tom.
Bob, what's your take on this in terms of what we were expecting, which is one rate cut getting priced in, one of them getting priced out, and what we did see, which is a
no change.
Inflationary mix of a downgrade to growth and an increase in inflation, but not as much as we were expecting. What's your take? Are you surprised?
I am surprised. I'm surprised they left in 2 cuts this year. Obviously, they're paying a lot of attention to the housing market and to the labor market. Both of those
I am surprised about 2 cuts.
Potentially cracking.
Yeah, President Trump weighing in earlier on the Fed today at a press conference. Take a listen to what he had to say.
Maybe I should go to the Fed. Am I allowed to appoint myself, Doug? I don't know. Am I allowed to appoint myself at the Fed? I do a much better job than these people. So anyway, we should be 2 points lower.
Rich, how much do you think this is actually weighing on what we're hearing or what we're potentially going to hear from Fed Chair Jay Powell later today? This idea that there are a lot of people in markets saying that rates should be lower, and you also have the president increasing the pressure.
I don't think it's so much. Look, Jay Powell has a lot of experience with criticism from the White House, and so I don't think that's going to be a factor at all. But look, the inflation data has come in better than a lot of folks, probably even the Fed, expected. We are seeing some slowing in the labor market. You know, Lisa, I think a factor now is they're also having to deal with what is a fully employed economy given what's going on with immigration right now. So we're going to have probably some slowdown in the labor force from that. Engaging that is an additional complication to the decision, I think.
I'm going to do this for Stanley Fischer, the late, great Stanley Fischer. He lectured me, folks, a little bit of math time here. Lisa said, Farrow would never let me do math. We're doing math. I think it's a clarification, Bob Michael, that we talk about 2 rate cuts, and the President of the United States is talking about 8 rate cuts.
All right, so it was Fed revised down their 2025 GDP estimates from 1.7% to 1.4. 2026 are revised down from 1.8 to 1.6. Fed revised up. Fed dot plot still implies 25 bips of cuts, which I kind of disagree with. Either do shows 50 bips of cuts in total. I mean, they're gonna have to do like a 50 bip rate cut, or have to go and do 2 later in the year, depending on how the tariff impact is. But then what's weird is that the long end of the curve for their expectations goes back up. So they're essentially going to say we're going to go and blunt whatever the tariffs go and blunt for growth. We're going to go and essentially do a rate cut and then bring them right back, which I think is a little foolish. But
tinkering is the key thing here. We have a 50-year history, Claire is expert at this, of tinkering and not jump conditions like a real estate guy from New York.
Well, the tinkering will actually make the press conference a whole lot easier because it'll give Fed Chair Jay Powell a bit of a pass in dealing with some of the political questions. Joining us now, Diane Swonk of KPMG. Diane, were you surprised that this Fed leaned dovish at a time when even people in the market, putting aside President Trump, have talked about how inflation, as Rich just mentioned, has been coming in weaker than a lot of people had expected?
No, I'm not surprised. I think this is an important issue. The Fed says they're data dependent. They have to respond to that, but they're not going to cut right now. And that's the most important thing. We've got a forecast where the Fed is actually more stagflationary, which I think is what you pointed out. And that's important. And, you know, whether or not we believe it's 2 or 1.
If it's going to be 2, the market's implying that's going to be September and DAC for the rate cuts. And then pretty much a year from now, it says we're back to where we are, which I don't, like I said, I don't really get it.
In a staggered way that will show up later in the data, and that's what the Fed's waiting to see.
And Diane Swonk, the headline's simple here. Jennifer Pinero, thank you for this. 1.4% on growth and 3% on inflation. That's that Swonk stagflation that we're looking at. What's your conviction that we would see a reduced GDP level?
Oh, I think we will see a reduced GDP level, and I think that's what the Fed is also acknowledging and why they're saying they might go the full 2 points. It's actually not that far off from our forecast as well. And in fact, if they get the forecast that they're saying, this would be a forecast where inflation sort of peaks around 3.1% on the core and then starts coming down by year end, and they feel convinced that it will continue to come down by year end because weakness, the unemployment rate starts to creep up, but it doesn't creep up fast enough to trigger an official recession.
Diane, I'm so glad you mentioned this, Rich. And Rich, I would love your thoughts on this. You were talking about how
equity markets giving up some of their gains off of the announcement. Same thing with the bond market, and with the U.S. dollar broadly is regaining some of the weakness that it had. My guess is people kind of bought the press release and are kind of sell the press conference.
Raises the question, especially what you were talking about, the demographic shifts, just what this feels like in terms of the labor market tightness or not, given how much we have seen immigration affect the picture.
Sure. Well, because the immigration is going to show up in the growth in the labor force, and it's going to obviously show up in employment or unemployment. So I think it's a complication in the sense it makes their signal extraction problem even harder. I guess one thing I would say, Lisa, and I like the term policy purgatory, Diane, because I think it captures it
I
well.
do like that
One thing
term,
I would say
policy
is,
purgatory.
4.5 is a number, so we'll talk about it. But there's a big range of outcomes for the unemployment rate, especially 12 months down the road. So I think there's a chart in the SEP that will show uncertainty about unemployment, and that's probably pretty elevated as well.
Professor Clarida, are we unanchored? And I say that within the great central bank fear of lessons learned, particularly from Japan years ago. Oops, we raised rates. Oops, we got to turn around. Lots of oops. Are we unanchored where there's a new monetarist fear out there of monetary policy people, I should say?
We are unanchored.
Tom, I don't think so. There was a paper at the recent Fed conference about unanchored inflation expectations, so I know it's on some folks' mind. I don't think we are. In fact, I think Jay Powell's focus really right now for the remainder of his term is to be darn sure that when he leaves, that we are anchored. And I think, that's probably part of what's going on, and we'll hear about it today at the press conference.
Is there anything that gives you pause, Bob, about the idea that maybe we aren't really fully appreciating some of the inflationary risks at a time when, yes, the backward-looking data has been better than expected, but looking forward is pretty complicated right now?
I was sitting here thinking, actually, the Fed did almost exactly what everyone expected. They didn't hike rates. When I go through their forecast on GDP, inflation, and unemployment, directionally, they're where everyone was headed, so they kind of match that. And I think 3% inflation looks to us to be very aspirational. When I look at Mike Feroli's forecast, he has inflation peaking at 4.6% in the third quarter. And that's on a seasonally adjusted annualized rate, but that's a very high number. So I think, there is some risk that we may be underestimating what tariffs and higher oil prices could do to inflation, and whether the One Big Beautiful Bill Act has enough power into it that it helps to entrench higher prices.
And Diane Swonk, with your charm of the Midwest, there's one big beautiful interstate system out of Chicago moving south, which is directly affected by goods, tariffs, and the rest of it. What do you observe in the Midwest? Are the tariffs clicking in now? Advise the chairman.
Well, they may click in higher here in a little bit.
They know what's going on. They're hearing it from everywhere. And what we're starting to see is not only are firms doing whatever they can to mitigate the costs of tariffs, they're also starting to see some disruptions due to supply chain problems that you can't undo overnight. And I think that's very important as well. That's only just beginning to seep into the data, but it's very reminiscent of the pandemic.
What do we think?
And I think that's why the Fed is still on so much guard. And this is a purgatory for them because they are very concerned that the unemployment rate will rise, or it may not be signaling, as Rich said, what it might have otherwise signaled, because we'll have pockets of tightness where immigrants used to be and they no longer are. We're already seeing that in the care economy, and we've been tracking it, and the slowdown in elder care in particular, where there's a disproportionate amount of foreign-born workers in that area, that employment has fallen basically to nothing. And in fact, that's where inflation is also moving up at several times.
Now, chat, this is an interesting chart from the great guys over at Bespoke Investments. Essentially how the S&P does during Fed days with the area shaded being post meeting, or it would essentially be post announcement, because the announcement's always at 2 p.m. Eastern time. And then the press conference starts right here. So essentially you want to sell at 3 p.m. right before the press conference is over. And that's pretty much where all your gains are. I mean, it's only 0.25%, but if you hold, coming into it, you lose about 0.15%. So interesting chart there.
lower their GDP estimate to 1.4% from 1.7% in the March summary
so
of
far,
economic projections, and lifted inflation from 2.8 to 3%, but they still kept their rate cut expectations the same, talked about uncertainty diminishing, but still elevated.
If we look at where we kind of started doing that, although it's kind of the opposite at the moment, but
to me, the arch issue, I've said
this is cat, that's why.
The Bramall Cam once got her. She was very upset at me boring her with this. Can you aggregate America? If you're Richard Clarida at the Fed,
there we go.
At Deutsche Bank, or Bob Michael at J.P. Morgan, Greg
I'll
Peters,
stack them on top of each other. That way
you
can go and kind of
American economic data, or is it a barbell economy of those healthcare workers Diane Swank just spoke about? They're desperate and unreplaceable, or fancy people you're living with every weekend north of New York City. I mean, which is it?
Well, you know what? This is a great time to bring in Matt Lazzetti of Deutsche Bank to answer all of those questions and address them. Matt, thank you so much for being with us. Let's start with your reaction. Do you view this as a dovish move by the Fed, as it seems to be treated in markets?
Look, I think it skews slightly dovish. We thought in a very close call that they would go to one rate cut this year rather than 2 rate cuts.
2-year up
but when
a
you
bit.
look at the overall change in their economic forecast, is very much in line with what we anticipated.
10-year rates back to where they started at. On all my FX, are pretty much right where we started back at. S&P pretty much unchanged. VIX unchanged. Typical. Kind of buy the announcement, sell the news, wait till the press conference for any type of looks either way. Chat, let me know if you think any differently. Here's something from JP Morgan's Ferroli, their head economist. The Fed left rates on hold again today as universally expected, and the median dot for this year was unchanged relative to March. Still looking for 2 cuts for next year. Still looking for 2 cuts. For next year, the median dot now looks for 1 cut instead of the 2 expected in March, and 1 further cut in 27. The longer run dot has unchanged at 3%. This year's median dot was a little more dovish than we expected, which many relate to the inflation forecast this year being a touch more optimistic than we thought. Core PCE was only revised up to 3.1% from 2.8% in March. The statement also shaded on the optimistic side. As it noted, while still elevated, uncertainty about the outlook has diminished. It also dropped the May statement's reference to risk higher and inflation higher, unemployment reference to risk of higher inflation, higher unemployment. Powell speaks here in 13 minutes.
Trade policy uncertainty of a fiscal package that's coming through. But overall, on a trend basis, we're quite supportive and kind of constructive on productivity growth.
Taking a step back in terms of the uncertainties that the Fed is going to be having to deal with, there's a question about oil and how much it matters or doesn't. We're used to saying oil doesn't matter. You strip it out from core inflation and you take a look at what does matter. And yet it does seem to trickle into inflation expectations and potentially some of the costs of goods around the board. I'm just wondering, and I would love Rich and Bob to weigh in too, but Matt, from your perspective, how important is it to both growth and inflation to understand whether this is a sustainable level of oil prices that we've seen in the terms of the $16 rise since that May 7th meeting, the last time the Fed gathered?
Yeah, in terms of the growth impact, I think that impact has moderated over time as we've become a net exporter and energy production has become more important within the U.S. Obviously, it lifts headline inflation in the near term with a far more modest pass-through to core inflation as we look ahead. But I think you're exactly right, Lisa. The key area to focus is on inflation expectations because all measures that we have are highly sensitive to oil prices, including long-run market-based measures. So if you look at the correlation between oil and five-year break-evens or inflation swaps, that correlation is about 75% since 2014. And so if you do have a spike higher in energy prices, I think above these levels, most importantly, I think that is something that could move inflation expectations to more worrying levels for the Fed.
And Rich, what's your take on this? Because we heard from Bob that maybe we are underestimating just how inflationary not only the one big beautiful bill is and also the tariffs, but potentially also the oil price spike that could alter longer-term inflation expectations.
Exactly, Lisa. I think, again, given the history, they are attuned and attentive to inflation expectations. They don't take them being well anchored for granted. You know, the Fed and other central banks have a lot of experience over now decades of how to look through oil prices. But I think Matt is exactly right. In the context of where we are currently, with the history and also with the tariff uncertainty, I think it's yet another thing for Jay Powell and the committee to worry about, which is probably, again, why they're on hold at this meeting.
Bob, what do you expect him to say about this? The idea that traditionally oil price surges can be disinflationary, inflationary, stagflationary. How will he message it at a time where we do have enough certainty that he does, as you said before, have to give some answers?
Well, I think he'll point out a lot of things. I think he'll point out that the Fed understands it's one of the biggest household expenditures. So higher oil prices could translate into higher prices for gas at the pump, and that could cause households to pull back on expenditures elsewhere. I think he'll go back to things he's always been saying. It's about inflation expectations. Are they concerned that this becomes embedded in prices going forward, and then
they probably are extremely concerned on that.
A sensitive question, Richard Clarida. I believe you were on the watch when Putin invaded Ukraine the second time, 2022. How does the Fed talk about geopolitics? Around the table, how do you talk about war?
Well, actually, I had moved on from the Fed at that point, but in general, geopolitics is an ever-present uncertainty. Sometimes it spikes, as it is recently, at least in my experience, and the minutes and the transcripts show this. It's a pretty clinical, analytical discussion of how it feeds into inflation, demand, supply. At least in my experience, Fed commentary doesn't really go into the politics side of the geopolitics, more just the economic side.
Matt Lozzetti, I think one thing important here, Bob Michel mentioned this earlier, is the surprise that yields aren't higher, whatever anybody can believe. Ken Rogoff mentioning 5, or I think at one point he got out of control and mentioned a 6% 10-year. Matt Lozzetti, are you surprised that yields aren't actually higher right now?
I think given some structural factors, the answer is probably yes. So the budget deficits that we are running here in the U.S., the outlook for the debt to GDP ratio, the idea that inflation might be somewhat higher and more volatile, and bonds may not be as good of a hedge for equities. All those suggest, I think, over the more medium term, long-term yields are likely rising and term premium are likely to be higher. In the current environment, however, I think that is being offset by cyclical considerations and cyclical concerns, at least. And those concerns are still around the possibility that the uncertainty shock that we've had from trade policy and the impact of trade policy uncertainty will lead to weaker growth outcomes, a weaker labor market outcome, and that the Fed could need to cut meaningfully at some point in time. I think for the long end of the curve to kind of dislodge meaningfully higher and on a sustained basis, you probably need those concerns to completely dissipate, and we're certainly just not there yet.
I mean, Bob, the history here, the Young crew, including Young Lozzetti, they 45 basis points on the vanilla 2s and 10s, a difference between the 10-year and the 2-year yield. You and I recall 200 basis points, 2 full percentage points difference. Are we just going to get used to a steeper yield curve?
Tom Pooh, we used to do 45 basis points on the curve in a day. This is total nonsense. But I think actually Mr. Lozzetti is right. He hit the nail on the head. It's going to take time to get there. You are still living in a post-Great Financial Crisis world where most of the investors who are sitting on desks only know a 0 to 2% Fed funds rate.
Right.
So this looks extreme to them. I think it's going to take time to mean revert to the normal that existed pre-financial crisis. Remember that first Fed dot of neutral policy long-term was 4.25%. It wasn't 2. It wasn't 3. It was 4.25%.
Okay, now my idea is James Diamond's going to have a phone call. He's going to be in Central Park running. He's going to get a phone call from the president, and they're going to explain Bob Michel's x-axis here. President Trump's x-axis doesn't look like Jerome Powell's. How do you explain to President Trump to have patience to get the market to normalize away from the oddities of the last 5, 6, and 7 years?
Well, I think you have to look at how things look pretty healthy right now. Yes, there are storm clouds on the horizon, but we've now been talking about them for 2 quarters, and they haven't actually materialized yet. I know housing and the labor market feel a little bit softer, but the hard data hasn't actually reflected the breakage.
Rich, come on in here. Do you agree with this? I mean, honestly, I've heard this discussion so many times. I remember back in the day when I got a mortgage at 10%. At the same time, no one mentions the fact that their house cost about $90,000. So just saying, it was a very different time asset price-wise. Do you think...
At the table
this is something that people always argue that. And I love that you said puh. But I'm just curious, Rich, from your perspective, is that something that this economy can handle? Rates where they are on the long end and even going higher in this sort of adjustment period that we hear Bob and even Matt talking about?
Well, you know, Lisa, we've been, the 10-year's been in this range of roughly the high 3s to just under 5 now for 2 years. We really got into this at the last Fed hike in July of 2023. The economy is handling it. We do think a higher real term premium is what investors are going to require in order to hold this debt. You know, we've talked about the bad news on deficits, but this bad news has been really priced in for a while. So we think the economy can handle it, will handle it. We do think that the curve eventually will steepen. Inverted or flat as a pancake curves are not the new normal, but it will take Fed cuts, as I think Matt Luzetti mentioned a moment ago, for that steepening to be actually realized.
Matt, there was a feeling yesterday that maybe if there were some regulatory changes at banks that would help the long end of the yield curve, that would suppress yields. And I'm talking about the supplemental leverage ratio and how there was discussion, and the Fed's going to meet to discuss it, about potentially allowing banks to hold more treasuries without getting penalized for it or having be charged anything. Do you think this would materially shift anything in addition to maybe adding some incremental liquidity? Would it actually cause banks to go out there and be bidders, be net buyers of treasuries in a new kind of way?
I think the impact is likely at the margin. I think many banks you don't actually think is being constrained by the SLR at the moment, and therefore easing up a little bit, I think, may not have as big of an impact as anticipated. I think also there was actually some hope or optimism that there'd be even greater relief around SLR, for example, excluding treasuries from the ratio. And so kind of the news reports around just kind of dropping the rate, I'm not sure are going to have as big of an impact as anticipated. But I think as you take a bigger picture on this, what you do see, and I think what's been hinted at by Rich and maybe Bob, is this idea that, look, I think foreign investor demand for U.S. treasuries and U.S. assets is likely to be declining over time. It looks like we are set to continue to run budget deficits as a share of GDP that are 6.5% to 7% over the next several years. And it makes sense, I think, for the administration to look for ways to free up some demand from the domestic financial sector. And this is one way, at least at the margin, that they're looking to do so.
Rich, out on YouTube live chat, I'm getting torn asunder here. I mentioned the x-axis. This guy says, for those of you way in the back, the x-axis refers to time. Speaking of time, does a chairman have to come out, Rich Clarida, today and make a clear statement of Fed independence?
I don't think he needs to lead with that. He'll almost certainly get a question from the reporters. You know, again, Jay Powell's now been doing this for 7 years, and I think he has a record that doesn't really need to be defended in that way. So I'm sure the question will come up, but I don't think he needs to lead with it, no.
Well, we do this every time before the Fed meeting. Imagine all three of you are in the room at that press conference. Bob, I will start with you since you always have your question handy. For Fed Chair Jay Powell, what would you ask if you were in that press conference?
I'd ask him how they modeled revenue coming in from tariff policy, because
that's
right
a very
now
good question.
The CBO scoring is at $2.8 trillion.
All right, chat, time to wake up because we got the press conference starting right now. We're going to go and hear Jay Powell speak here in just a second. Then there's going to be Q&A for the next 45 minutes-ish. So this is where we may go and get some more meat on the bones here. So wake up, pay attention, get up from that nap. Going into this, we've got equities that are essentially flat. Yields have risen quite a bit, a decent amount, and the dollar has strengthened a bit as well since we got the press statement. But we are coming into the presser. It's the presser in the Q&A. Get ready. Big man Powell's going to walk out. My prediction is he's going to be wearing a purple tie because he always wears a purple tie. Do we have any tie guesses? Any tie guesses in the chat? Anyone guessing what tie he's got on? Can I get a tie color check?
I would say, I'll be less than graceful. He's got to say something to reaffirm McChesney Martin, 1951.
Well, and he has come out and said that
the
Fed is
even more
absolutely independent from any kind of pressure. At the same time, the pressure is coming from markets as well, and I think that's important. That people in markets are saying there are signs of cracking in the labor market, there are signs of cracking in the housing market, there are signs of cracking even in retail sales, albeit it's a complicated picture. How does he respond to that? Jerome Powell is walking to the podium for the press conference. He is beginning his news conference. Let's listen in.
Good afternoon. My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. Despite elevated uncertainty, the economy is in a solid position. The unemployment rate remains low, and the labor market is at or near maximum employment. Inflation has come down a great deal, but has been running somewhat above our 2% longer run objective. In support of our goals, today the Federal Open Market Committee decided to leave our policy interest rate unchanged. We believe that the current stance of monetary policy leaves us well positioned to respond in a timely way to potential economic developments.
I agree.
I'll have more to say about monetary policy after briefly reviewing economic developments. Following growth of 2.5% last year, GDP was reported to have edged down in the first quarter, reflecting swings in net exports that were driven by businesses bringing in imports ahead of potential tariffs. This unusual swing has complicated GDP measurement. Private domestic final purchases, or PDFP as we call them, which excludes net exports, inventory investment, and government spending, grew at a solid 2.5% rate. Within PDFP, growth of consumer spending moderated, while investment in equipment and intangibles rebounded from weakness in the fourth quarter. Surveys of households and businesses, however, report a decline in sentiment over recent months and elevated uncertainty about the economic outlook, largely reflecting trade policy concerns. It remains to be seen how these developments might affect future spending and investment. In our summary of economic projections, the median participant projects GDP to rise 1.4% this year and 1.6% next year, somewhat slower than projected in March. In the labor market, conditions have remained solid. Payroll job gains averaged 135,000 per month over the past 3 months. The unemployment rate, at 4.2%, remains low and has stayed in a narrow range for the past year. Wage growth has continued to moderate while still outpacing inflation. Overall, a wide set of indicators suggests that conditions in the labor market are broadly in balance and consistent with maximum employment. The labor market is not a source of significant inflationary pressures. The median projection for the unemployment rate in the SEP is 4.5% at the end of this year and next, a bit higher than projected in March. Inflation has eased significantly from its highs in mid-2022, but remains somewhat elevated relative to our 2% longer run goal. Estimates based on the Consumer Price Index and other data indicate that total PCE prices rose 2.3% over the 12 months ending in May, and that, excluding the volatile food and energy categories, core PCE prices rose 2.6%. Near-term measures of inflation expectations have moved up over recent months, as reflected in both market and survey-based measures.
Makes sense.
Respondents to surveys of consumers, businesses, and professional forecasters point to tariffs as the driving factor.
Yes.
Beyond the next year or so, however, most measures of longer-term expectations remain consistent with our 2% inflation goal. The median projection in the SEP for total PCE inflation this year is 3%, somewhat higher than projected in March. The median inflation projection falls to 2.4% in 2026 and 2.1% in 2027. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. At today's meeting, the committee decided to maintain the target range for the federal funds rate at 4.25% to 4.5% and to continue reducing the size of our balance sheet. We will continue to determine the appropriate stance of monetary policy based on the incoming data, the evolving outlook, and the balance of risks. Changes to trade, immigration, fiscal, and regulatory policies continue to evolve, and their effects on the economy remain uncertain. The effects of tariffs will depend, among other things, on their ultimate level. Expectations of that level, and thus of the related economic effects, reached a peak in April and have since declined. Even so, increases in tariffs this year are likely to push up prices and weigh on economic activity. The effects on inflation could be short-lived, reflecting a one-time shift in the price level. It's also possible that the inflationary effects could instead be more persistent. Avoiding that outcome will depend on the size of the tariff effects, on how long it takes for them to pass through fully into prices, and ultimately on keeping longer-term inflation expectations well anchored. Our obligation is to keep longer-term inflation expectations well anchored and to prevent a one-time increase in the price level from becoming an ongoing inflation problem. As we act to meet that obligation, we will balance our maximum employment and price stability mandates, keeping in mind that without price stability, we cannot achieve the long periods of strong labor market conditions that benefit all Americans. We may find ourselves in the challenging scenario in which our dual mandate goals are in tension. If that were to occur, we would consider how far the economy is from each goal and the potentially different time horizons over which those respective gaps would be anticipated to close.
Very interesting.
For the time being, we are well positioned to wait to learn more about the likely course of the economy before considering any adjustments to our policy stance. In our SEP, FOMC participants wrote down their individual assessments of an appropriate path for the federal funds rate based on what each participant judges to be the most likely scenario going forward. The median participant projects that the appropriate level of the federal funds rate will be 3.9% at the end of this year, the same as projected in March. The median projection declines to 3.6% at the end of next year and to 3.4% at the end of 2027, a little higher than the March projection. These individual forecasts are always subject to uncertainty, and as I've noted, uncertainty is unusually elevated. And of course, these projections are not a committee plan or decision. At this meeting, the committee continued its discussions as part of our 5-year review of our monetary policy framework. We focused on issues related to assessing the risks and uncertainties that are relevant for monetary policy and the potential implications for policy strategy and communications. Our review includes outreach and public events involving a wide range of parties, including Fed Listens events around the country and a research conference that we held last month. We are open to new ideas and critical feedback, and we will take on board lessons of the last 5 years in determining our findings. We intend to wrap up any modifications to our statement on longer-run goals and monetary policy strategy by late summer. After that, we will consider enhancements to our suite of communications tools, including the SEP. The Fed has been assigned 2 goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing inflation sustainably to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We understand that our actions affect
It's very interesting that they mentioned if the 2 policy goals get out of bounds, they got to go and they'll take an assessment onto which one to focus on first.
Do everything we can to achieve our maximum employment.
That so far has been the most interesting thing that they've said.
Thank you.
That implies that one of them is going to get out of bounds.
Thank you. Colby Smith with the New York Times. To what extent has the more limited impact from tariffs at this stage on inflation changed your view on what the ultimate economic fallout will be from these policies and the timing of when they will materialize in the data?
The answer is we don't know because we don't know when tariffs are going to be fully in place.
We've had 3 months of favorable inflation readings since the high readings of January and February, and that's, of course, highly welcome news. Part of that just is that services, core services, both housing services and non-housing services, have really been grinding down toward levels that are consistent.
Also, no real changes in interest rates,
we've had
FX or equity since Powell started talking.
And of course, we expect, as you point out, we do expect to see more of that over the course of the summer. It takes some time for tariffs to work their way through the chain of distribution to the end consumer. A good example of that would be goods being sold at retailers today may have
Don't
been
come in
imported
here and
several months
crypto.
ago before tariffs were imposed. So we're beginning to see some effects, and we do expect to see more of them over coming months. We do also see price increases in some of the relevant categories like personal computers and audiovisual equipment and things like that.
That
are
is where some
attributable
inflation
to
is.
tariff increases. In addition, we look at surveys of businesses, and there are many of those, and you do see a range of things, but many companies do expect to put all
Hell no.
or some or all of the effective tariffs.
stick to
through
on
the
best
next-
stat, which
in the
is
next
probably
person
trading.
in the chain,
Oh.
and ultimately to the consumer. Today, the amount of these, the amount of
Dollar
the tariff
gain a
effects,
boost
the
here.
size of the tariff effects, their duration and the time it will take are all highly uncertain. So that is why we think the appropriate thing to do is to hold where we are as we learn more. And we think our policy stance is in a good place where we're well positioned to react to incoming developments.
So in terms of how we should interpret the rate cuts penciled into the SEP, is this reflecting that there's this expectation that underlying inflation will just stay well enough contained that allows the committee to eventually move ahead with those cuts? Or is it about responding to a deterioration in economic activity, let's say? I mean, how should we make sense of the forecast?
So if you look at the forecast, you will see that people do generally expect inflation to move up and then to come back down. But we can't just assume that. Of course, we don't know that. And, our job
two
is
cuts
to
are
make sure,
to maintain
one of our jobs is
flexibility.
to make sure that a one-time increase in inflation doesn't turn into an inflation problem. And that, again, that will depend on the size of the effects, how long it takes for them to come in, and ultimately on keeping inflation expectations anchored.
Hi, and thanks, Chair Powell. Howard Schneider with Reuters. If you look at the rate path starting in December to today and adjusted over the full time horizon you've got there, you've taken about a quarter point per year out of your projected path, and you end at a higher rate at N2027 than you would have in the prior forecast. Is that a result of a sense that tariffs will lead to more persistent inflation? Is it a result of reassessments of where your short-term neutral rate is? Why are you on a slower path now?
So I would focus most on the nearer term as you get out to the.
I would say it's probably
later
more degrees
years.
of freedom.
It's hard for anybody to know where the economy is going. You didn't see people moving their longer term, estimate of the neutral rate, for example, at this meeting. So and those things are probably slow moving. So I think if you look at what's happening here since March, this is since March, right? You see a little slower growth, just a tiny
equities
tick
like
up,
it.
a 1/10 tick up in
Equities are shining like it.
unemployment, and you see inflation moving up 0.3. And by the way, it was a similar move from the December SEP to the March. So that's what you see. You see the effects of tariffs. I think we learned in April, after the March meeting, that substantially higher tariffs were likely. And then since then, the estimates of where the tariffs will be have actually moved back down, although still at an elevated level. So we're adapting in real time. And what you see is an accumulation of individual assessments.
You say in the statement that risks have diminished on that front, but the July 9th, drop dead date for all the Liberation Day tariffs is still out there and unresolved. You've got now exchange of missiles between two Middle East adversaries with a possible U.S. involvement. How can you justify saying that risks have diminished?
So what we said was that uncertainty uncertainty about the economic outlook has diminished but remains elevated. Many surveys say that. They do. So, and that's actually a line from the Teal book, which you can see in 5 years. Remember to check that.
Maybe the world will be over.
No, but if you think about it, tariff uncertainty really peaked in April, and since then has come down, and that's really what that's just acknowledging. It's diminished, but still elevated. That it's uncertainty. So I think that's an accurate statement.
That's kind of a no answer, in my opinion.
Thank you. Chris Rugaber at Associated Press. There is an argument out there in favor of cutting rates more immediately. Inflation has continued to cool and is back to roughly 2% despite the tariffs. And I guess I also wanted to ask about cracks in the job market with gross hiring slowing, concentrated in just a few industries. We've seen some housing data, including this morning, that has been pretty weak. Do you see any concerns that the economy is weakening and that is a reason to cut rates going forward?
So we do of course monitor all those things. I think if you look at the overall picture, what you're seeing is 4.2% unemployment and an economy that's growing at a rate.
He's going to go and say the economy stable.
Unusual flows in the first quarter, but it appears to be 1.5–2%, maybe a little better than that. Sentiment has come up off of its very low levels. It's still depressed. So you can point to things. The housing market is a longer run problem and also a short run problem. I don't think it's indicative of basically the situation is we have a longer run shortage of housing, and we also have high rates right now. I think the best thing we can do for the housing market is to restore price stability in a sustainable way and create a strong labor market, and that's the best thing we can do for the housing market. You asked about the job market. Again, look at labor force participation, look at wages, look at job creation. They're all at healthy levels now.
Stable, healthy,
I would say
same thing.
You can see perhaps a very, very slow continued cooling, but nothing that's troubling at this time. But we watch it very, very carefully. So overall, again, the current stance of monetary policy leaves us well positioned to respond in a timely way.
Well, dollars liking this, stocks and equities are liking this, and bonds are not liking this.
Well, just
bond yields higher.
Given that there are concerns inflation will rise, but there is the alternate scenario that tariffs would create demand destruction and slow growth sufficiently, and that would perhaps keep a bit of a lid on inflation. Do you see odds of that scenario? What kind of odds do you see of that scenario coming true, and how many months of cool inflation would you need to see before concluding that maybe that lower inflation scenario is taking place?
So this is very much the conversation we had today and yesterday. There are many, many different scenarios, many combinations of scenarios where inflation does or doesn't prove out to be at the levels we think, and where the labor market does or doesn't soften. And I think what you see people doing is looking ahead at a time of very high uncertainty and writing down what they think the most likely case is. No one holds these rate paths with a great deal of conviction, and everyone would agree that they're all going to be data dependent, and that you can make a case for any of the rate paths, I think, that you see in the SEP.
I don't like that this is a headline. No one holds these rate paths with great conviction.
Particularly at this time. But it does reflect, if you see somebody writing down, a rate path that involves cuts, that's them saying, yes, I think we will get to a place, more likely than not, where cuts will be appropriate. And it could be a joint probability of a number of possible outcomes. Again, remember how much uncertainty we face, though.
Thank you. Mr. Chair, I wonder if you could describe for us some of those scenarios. How do you get to a place? I'm noticing that the uncertainty levels in your forecast are very high. How do you get to a place where you have the confidence in the outlook for, say, inflation and or growth or the unemployment rate? How many months does it take, and what do you want to see in the data to get to that level of confidence to actually reduce rates off the restrictive level?
So it's very, very hard to say when that will happen. We know that the time will come. It could come quickly. It could not come quickly. As long as the economy is solid, though, as long as we're seeing the kind of labor market that we have and reasonably decent growth and inflation moving down, we feel like the right thing to do is to be where we are, where our policy stance is, and just learn more. And in particular, we feel like we're going to learn a great deal more over the summer on tariffs. We hadn't expected them to show up much by now, and they haven't. And we will see whether, to the extent to which they do over coming months. And I think that's going to inform our thinking.
Especially since we could get additional tariff rates
at some point
here in 2 weeks.
Clear. I can't tell you exactly when that will be. And meanwhile, we'll be watching the labor market very carefully for signs of weakness and strength, and tariffs for signs of what's going to happen there. And of course, there are many developments ahead. Even in the near term, developments are expected on tariffs. So I think we don't yet know with any
Meanwhile, the
confidence
dollar
where
is
they
really
will
liking
settle
this.
out. We have an estimate, and it's I think all estimates are now pretty close together, but it's again highly uncertain.
When you say estimate of the impact of tariffs on the core PCE, is that what it is? And could you share that?
What you start with is what's the effective tariff rate overall, and people are managing to that. But the pass-through of tariffs to consumer price inflation is a whole process that's very uncertain. As you know, there are many parties in that chain. There's the manufacturer, the exporter, the importer, the retailer, and the consumer. And each one of those is going to be trying not to be the one to pay for the tariff. But together, they will all pay for it together, or maybe one party will pay it all. But that process is very hard to predict. And we haven't been through a situation like this. And I think we have to be humble about our ability to forecast it. So that's why we need to see some actual data to make better decisions. We'd like to get some more data. And again, in the meantime, we can do that because the economy remains in solid condition.
AKA, we don't know how much of a tariff impact will be on the consumer versus companies. AKA, we have no idea if it's going to be higher PCE or CPI.
The divergence we see in the dot plot, particularly around the 2025 rate projections. I realize this is, you have one group of officials that are putting down no cuts, another that are putting down more than one. And again, recognizing that could be difficult to summarize, but is it a matter of people having a different outlook or a different reaction function, a different commitment to defending against another inflation mistake? How did that play out over the last 2 days?
So you're right. This is often the case. We have a pretty healthy diversity of views on the committee. We did have strong support for today's decision and broad agreement that our policy stance does leave us in a good place. But I would point to two factors, and you mentioned them. The first is just that parties have a diversity of forecasts, and they do align with where their dots are. So if you have a higher inflation forecast, you're going to be less likely to be writing down, more cuts. But remember, as we see more data, we're going to learn more about where inflation is headed, and that means when it is time to look at resuming our normalization process, the differences you see should be smaller because we'll have seen actual data. Right now, it's just a forecast in a very foggy time. So that's the first part, is forecast. Secondly, people can look at the same data and they can evaluate the risks differently, as you know. And that includes, the risk of higher inflation, the risk that it'll be more persistent, the risk that the labor market will weaken. People are going to have different assessments of that risk. So that you put that in there too. So those are the two ways that the two things I think that drive these things. Remember though, as I mentioned earlier, with uncertainty as elevated as it is, no one holds these rate paths with a lot of conviction. So that's really where it is. It's a function of those things. And I think as the data come in, you should see those differences diminish.
If I could follow up, you've said the policy is in a good place and that it's modestly restrictive. Given all the uncertainty you just talked about, tariff levels, uncertainty around the pass-through, is it price increases versus margin compression, some of the softness that Chris talked about in labor and housing, why wouldn't it be better to have rates at a more neutral setting as the economy heads into this period of very high uncertainty?
So if you just look backward at the data, that's what you would say, but that's not. We have to be forward-looking. And the thing that every forecaster, every outside forecaster, and the Fed is saying is that we expect a meaningful amount of inflation to arrive in coming months. And we have to take that into account. So I think a backward-looking look would lead you to a neutral stance, but we can't. We have to look at that, and because the economy is still solid, we can take the time to actually see what's going to happen.
Euro about to give up all the gains on the day.
How large the inflation effects and the other effects are going to be. So we'll make smarter and better decisions if we just wait a couple of months or however long it takes to get a sense of really what is going to be the pass-through of inflation and what's going to be the effects on spending and on hiring and all those things.
10-year yield now positive on the day. Equities take a turn lower.
Bloomberg Radio and Television. Your friend down at 1600 Pennsylvania Avenue continues
to
insults in your direction, and I'm wondering.
Paul's he's not going to answer it.
Maybe carved out the Fed from some of the.
He's not going to answer the question. He never answers these questions.
Just noise that the markets and everybody should ignore until your term is up, or whether you worry that it could lead to more pressure on confidence on Wall Street, on consumers about the outlook for the economy.
Look, from my standpoint, it's not complicated. What everyone on the FOMC wants is a good, solid American economy with strong labor market and price stability. That's what we want. We think our policy is well positioned right now to deliver that and to be able to respond in a timely way as the data lead us around. The economy's been resilient, and part of that is our stance. And again, we think we're in a good place on that to respond to significant economic developments. That's what matters. That is what matters to us.
Wasn't going to answer.
Pretty much that's all that matters to us.
Dollar on the highs of the
I need
day.
to ask, assuming you are not reappointed, would you stay on as governor when your term as chair ends?
I'm not thinking about that. I'm thinking about this.
Why even answer? Why even ask the question? You knew
Thanks,
you know
Mr.
exactly how
Chairman.
he was going to ask it. How he was going to answer.
I guess with workplace raids increasing, picking up significantly, what kind of effect would that have on the labor market
Sorry,
in the short
with
term?
what picking up?
Workplace raids.
So you're asking immigration?
Yeah.
You know, I wouldn't want to speculate. One way to get at that from an economic standpoint, we of course don't comment on immigration policy. It's not ours to make or comment on. But what you see is an unemployment rate that has been really solid and at a low level, not really increasing. It's been in a good range and well within the range of mainstream estimates of maximum employment. And that means, like, part of that is that labor demand and labor supply are kind of moving down at the same rate. Labor demand is softening. You see that in job creation, but it's still kind of at a healthy level. And labor supply is diminishing because the immigration numbers that we see are much lower than they were. So those two factors, supply and demand, that's what has kept the unemployment rate in a reasonably stable place.
Okay, thanks. The other thing I wanted to follow up on is if you could elaborate on the potential changes to the SEP that you suggested were part of the framework review, I think.
So the framework review really has two tracks, right? The first track is our policy framework that is reflected in the consensus statement. And we've said that we would finish that and announce it by the end of the summer. So we're well along in that process. We've had the meetings that we need to have, and we're now going to be going into, into discussions
Get this guy some water.
Specific changes to language. So that's the framework part of it. The second part of it is our communications tools and practices. Pardon me. And that part comes next. Okay, that's what we're going to do in the meetings this fall. Actually, what we did at this meeting, though, is we sort of prepared the ground for that. We had a meeting where we talked at a high level about a number of ideas. The SEP is part of it. Many other ideas. It's sort of how do we think our communications can be improved? There are a number of ideas. People offered a really, it was a great conversation, number of ideas, but we're going to look at those with staff briefing and a lot of thought in the fall. And I would say when it comes to changing communications, I would only support things really that only implement things that have very broad support. And also you want to be really careful because I think our communications are pretty well received. They're not broken. So more is not necessarily better, but better is better. So we're going to be looking at ways to do things that will improve the clarity of what we do for the benefit of the public.
Thanks, Chair Powell. Kelly O'Grady, CBS News. You're famously
he's breaking out the water.
as
There
the
we
guy
go.
that makes decision based on data instead of speculation. You've said today the inflation data is in a good place. We don't know how tariffs are going to impact prices going forward. That's uncertain. But I've got to go back to the last time that you cut rates in December, and there was still the what if of tariffs. So what made you feel comfortable cutting then when inflation was higher than where it is today and you didn't cut today?
Well, the forecast for inflation in December was
equities on the
2.5.
lows,
Core PCE for 2025.
yields on the
forecast was
highs, dollar on
2.5%,
the highs.
which is a good inflation forecast. I think what we've learned is that, and this was long before we had any idea of what the actual policies would be. We've learned that tariffs are going to be substantially larger than forecasters generally thought, and we don't. Our forecasts are generally not particularly different from those of other, well-resourced forecasting operations. So, what we learned, and particularly in April, was that very substantially larger tariffs were coming, and that would mean higher inflation. That's what happened, and so you saw 2.5% forecast in December, you saw 2.8% in March, and you see 3.1% now. So it's 0.6 higher inflation for 2025, and that's a big part of the change, and that's due to the effects of the tariffs
Chad.
that are, we don't know where they're going to land, but it's pretty apparent they're going to land higher than outside forecasters were really guessing at the end of last year.
My follow-up to that, I think consumers, right, we're looking for relief on rates when it comes to mortgages, car loans, small businesses want to take out more manageable loans. When you look at the cumulative inflation over the past 5 years, prices have risen over 20%. It's been a rough road. So what is the tipping point then for the wait and see approach in terms of how much it's going to help versus when it hurts the American consumer?
Well, I mean, we're trying to restore price. The best thing we can do for the public that we serve is restore price stability. If we can, and we will, restore price stability, meaning 2% inflation on a durable, sustainable basis. That, and also maximum.
Yeah, Euro risk reversals
we
are getting
restore those
absolutely
things.
crushed.
That's the best thing, and that is our goal. The best thing we can do for the American people, for households and businesses, that is the ultimate thing that we can deliver. And they can make their decisions without having to think about inflation all the time. So in the meantime, we have to keep rates high to get inflation all the way down. They're not very high, let's be honest. I would say policy is modestly or moderately, probably modestly now restrictive. If you look at the economy, it's not performing as though it were performing under very strict monetary policy, very restrictive monetary policy. So I would say probably modestly restrictive. And so what it will take is confidence that inflation is coming down. Now, I would say without tariffs, that confidence would be building, because if you see what's happening with non-housing services and housing services, which are the other two big pieces other than goods, those are coming down really nicely now. So I think we have to learn a little more about tariffs. I don't know what the right way for us to react will be. I think it's hard to know with any confidence how we should react until we see really the size of the effects.
My friend just chatted me, and he was pointing out a decent sized move in
I think we can
euro dollar
take
options.
the time
I was
to do
checking that out.
because unemployment is 4.2%.
So it has been a semi-decent move in the euro
Wages
today.
are moving up at a healthy clip now, and inflation is 2.3% headline inflation over a 12-month basis. So it's a good economy and a solid economy with decent growth.
Dollar is moving aggressively higher.
So you're saying that uncertainty has come down, the economy is moving at a solid pace.
Yen's almost given up all of its
inflation
gains.
has come down over the past 3 months, and this is all moving in the right direction. So are you indicating here that Americans should expect some sort of economic pain in the second half of the year?
I'm not saying that at all. From our standpoint, what I can say is that the U.S. economy is in solid shape. Inflation has come down. The unemployment rate remains at 4.2%. As I mentioned, real wages are moving up. It's a good job creation is at a healthy level. Unemployment, again, as I said, low. Labor force participation in a good place. So, and what we're waiting for to reduce rates is to understand what will happen with really the tariff inflation. And there's a lot of uncertainty about that. Every forecaster you can name who is a professional forecaster with adequate resources and forecasts for a living is forecasting a pretty significant. Everyone that I know is forecasting a meaningful increase in inflation in coming months from tariffs, because someone has to pay for the tariffs, and it will be someone in that chain that I mentioned between the manufacturer, the exporter, the importer, the retailer.
Yeah, it's actually a pretty decent-sized move in euro
good of some
riskies.
kind, or just the consumer buying it. And all through that chain,
Sorry,
people
Chad.
will be trying not to be the ones who pick up the cost, but ultimately, the cost of the tariff has to be paid, and some of it will fall on the end consumer. We know that because that's what businesses say, that's what the data say from past. So we know that's coming, and we just want to see a little bit of that before we make judgments.
Someone's getting
Follow-up
their
on that.
dick kicked
You
in
spent
on
years
these.
though talking about how you're data dependent, and be a little more direct on this. Now you're
Same
making
thing in
decisions
sterling.
looking forward. Doesn't the data you're seeing today
Someone's
indicate there
Vana
should
just
be a
went
rate
out
cut?
through the roof.
Your monetary policy has to be forward-looking. That is elementary. You've got to be looking. I always talk about the incoming data, the evolving outlook, and the balance of risks. We say that over and over and over again, right?
Yeah,
So
someone's
it's
Vana
always
just got its
forward-looking.
dick kicked in.
If you know, at the very beginning of the pandemic, we cut rates to zero immediately. Nothing had happened. We just knew that it was going to be really bad. right? So we took very aggressive forward-looking because we knew things were going to be unusually difficult. So, of course, this is something we sort of know is coming. We just don't know the size of it. And again, the economy seems to be in solid shape. So the labor market's not crying out for a rate cut. Businesses, were in a bit of shock after April 2, but you see business sentiment, you talk to business people now, there's a very different feeling now that people are working their way through this, and they understand how they're going to go, and it feels much more positive and constructive than it did 3 months ago, let's say. So again, we think that our current stance of monetary policy is in a good place.
Thank you. Amara Mokwe with Bloomberg. Chair Powell, in February, you told Congress that the Fed is, quote, overworked, maybe not overstaffed. Then in a memo to staff in May announcing a deferred resignation program at the Fed, you said you wanted to ensure that the Fed was, quote, right-sized. Those two statements appear to be at odds with one another. Could you explain what changed in the roughly 3 months between those statements that made you decide that staff levels at the Fed should decline?
I don't see them at all as intention. So I was asked, is the Fed overstaffed? And I said no, and I sort of said as a pun, overworked but not overstaffed. People do work extremely hard at the Fed, and I know they work hard at Bloomberg too. So, but we do. We work hard, but I would say this. So we are careful stewards of public resources, and sometimes you need to show that. So there have been several times in our history, modern history, where the Fed has said, you know what, we're going to do a buyout. We're going to show the public, we're going to demonstrate that we are good stewards of public resources. So we thought, and I thought, that this is a time when we can, we grow at about, our headcount has grown at about 1% a year.
On the highs.
So over the course of a couple of years, we're doing a careful scrub of the board and all the reserve banks, and we're going to find 10% of employees who can do something else, where we can streamline our operations, and we think we can get there in a couple of years. We think we can do that, and we think this is without taking risk to carrying out our critical missions. So this is something you do very carefully, thoughtfully, and you do it again respecting that we have critical missions to carry out. I've had a lot of experience in my prior careers, with headcount reductions and things like that, and this is how you do it professionally. You do it carefully, thoughtfully, with a lot of planning, and you do it over a period of time. And I think the Fed will be fine. I think no one will notice any decline in our ability to carry out our missions, and I think it's just us wanting to demonstrate to the public that we are actually good stewards of their resources. We're effectively wiping out 10 years of headcount growth with this. So, I mean, we wanted to show that, that we're good stewards.
How is progress on reducing headcount going so far? Are you on track to meet the goal?
We're just at the very beginning. As you know, we're doing a buyout program. We're gonna hit that goal. I think many organizations find that they can do this. You don't want to do it every year or anything, but you can do it at intervals, and you wind up not interfering with your ability to perform your jobs.
Chat, what do we think so far of the news conference?
Claire Jones from the Financial Times. As you're no doubt aware, the Senate Finance Committee has tabled its version of the reconciliation bill this week, and I was wondering if you could tell me a little bit about the tenor of the debate at the FOMC over the past few days on fiscal policy and the degree to which that
I'm a bit surprised by the market move, to be honest,
for 2026.
Especially in rates in the dollar.
Yeah, so we don't sit around and debate or really discuss. We take fiscal policy as fully exogenous, and so we actually really didn't talk about the bill or the contents of it. It's still evolving. When it gets closer, remember also we have a very, very large economy, and that the effects will be at the margin, I expect that they may already be in, but they will be in by the next meeting. We'll make an estimate, but it's not a major thing. It's nothing that we discuss. It may have been mentioned a couple of times, but as something that's coming in. But I think the outcome is, we don't know the outcome yet there, so hard to be real specific.
Neil.
Thanks, Chair Powell. Neil Irwin with Axios. There have been some cutbacks in economic statistics collection in the last few weeks. Worries that long-running problems around funding and response rates may be getting worse. How much is this concern on your radar? How much confidence do you have that the gauges you're watching to assess the economy are reliable right now?
You know, two things. One,
do I know about options?
The data we get right now,
trade
we
options
can
professionally.
Do our jobs. I'm not concerned that we can't do our jobs. That's not the point. The point really is that we are starting to see, you know, layoffs and important gatherers of data are saying that they're having to cut back on the size of their surveys. That's going to lead to more volatility in the surveys. I think we should take a step back and, you know, from our standpoint, and I think the standpoint of businesses and governments and everyone, having really good data on the state of the economy at any given time is a huge public good. It helps, it not just doesn't help the Fed, it helps the government, it helps Congress, it helps the executive branch. More importantly, really, it helps businesses. They need to know what's going on in the economy. The United States has been a leader for many, many years in this whole project of measuring and understanding what's happening in our very large and dynamic economy. And I hate to see us cutting back on that because it is a real benefit to the general public that people in all kinds of jobs have the best possible understanding of what's happening in the economy and hence what's likely to happen. It's very hard to measure what's going on in the U.S. economy. If you read, there was a book called, well, it's really remarkable how many things you need to understand to estimate U.S. GDP. Very, very difficult, and it's so important that we get it right. I just would say it's not a place to I would want to keep investing in that, you know, for the good of the general public.
Victoria. Hi, Victoria Guida with Politico. So you're conducting this monetary policy strategy framework review, but next year we're supposed to have a new Fed chair, and I'm wondering if that affects at all the way that you're approaching this. How do you ensure that this framework will actually be durable?
You know, the framework document goes back to 2012, and it's the committee's document. It's not like we're going to invent a brand new way to do things. It's been an evolving document, so it shouldn't depend on who the chair is at all. It should depend on what's happening in the economy and what the committee wants to do. So, yeah, it isn't really tied to any particular chair. And you know, we used to renew it every year. Now we do it every 5 years. So, but I don't think I've never heard anyone raise this issue that, you know.
Some people might, in one of the Bloomberg chats I'm in, are discussing
I really don't think that's right.
about
it's not going to be up to me to decide.
If it's a pretty hawkish presser, and I said
not in any way.
The market thinks so. I don't really agree. I think it's just a lot more wait and see attitude. Which I mean, when it said
Powell, Matt Egan from CNN.
Like our forecast
Relatively
is our
low
forecast.
Gas prices this year have helped drive down inflation in recent reports, but that trend is starting to reverse given the crisis in the Middle East. How are you thinking about how the Israel-Iran conflict will impact the economy, especially inflation? And what lessons were learned during the 2022 period when another conflict, the Russia-Ukraine war, sent oil and gas prices skyrocketing?
Most of those increases are temporary.
Like everybody else is, what's going on. I really don't have any comment on that. You know, possible that we'll see higher energy prices. What's tended to happen is when there's turmoil in the Middle East, you may see a spike in energy prices, but tends to come down. Those things don't generally tend to have lasting effects on inflation, although, of course, in the 1970s, they famously did, because you had a series of very, very large shocks. But we haven't seen anything like that now. The U.S. economy is far less dependent on foreign oil than it was back in the 1970s. So, but there.
A quick follow-up. I've just got to ask you about artificial intelligence. Some
What a
technology
fucking
executives have
stupid
recently
question by
been
this guy.
warning that AI could wipe
Yes,
out
it's
a
gonna
large
be
chunk of
the impact on the labor market. I get it, but he's going to go and say it's going to be wait to be seen.
I'm wondering how concerned you are, if at all, about the threat that AI poses to employment.
So this is the question. The question really is, will AI be more augmenting labor or replacing labor? And I wouldn't, we all see those announcements, including one today. I wouldn't, overread a couple of data points because, AI should be creating jobs at the same time. It may be replacing, maybe doing both. Anyone who's done any work with it, with AI, will have been a little bit stunned at how capable it is. And it's just a different thing. So I think this is something that certainly has transformational potential. And probably we're in the very early stages of it. They say what you're seeing now compared to what you'll see in 2 years is going to be very different and even more effective. So I think it's really hard to know. Of course, there are optimists who feel like it's going to make everybody much more productive. And there are those who think it's going to replace an awful lot of jobs right across the income spectrum, white collar, blue collar, and everything. So I just don't know. We don't have a house view on that, but this is going to be a very important question for some time.
Greg.
Told you. Like, why ask it? Why waste all
Greg
our
Rapp
time?
from MarketWatch. I was wondering if you could step back a little bit, Chair Powell. There's a spate of articles and a lot of op-eds now in the newspapers saying that the U.S. economy and the global economy is going through this profound change, akin to the end of the Bretton Woods era in the 1970s. And don't you owe the American people some sort of explanation for what we're going through? I mean, I noticed earlier this month when you talked about Bretton Woods a little bit, and you said that Bretton Woods, the Fed staff had to change how the dollar movements of the dollar was impacting the economy. Are we going through something like that now? That are you having to change how you do monetary policy? Is it that fundamental a change underway? Thanks.
It's certainly a time of real change. From a geopolitical standpoint, from a trade standpoint, from an immigration standpoint, you see this not just here but everywhere. So there's quite a lot going on. It doesn't change the way we do monetary policy in the near term. I mean, and it doesn't change our objectives or what we need to do. And these things are not really our issues. They're really issues for elected governments. All of those issues are really for elected governments. But there's no question it's a time of real change, and very hard to see where that goes. Will it be? There have been many things written about how it's going to be a more inflationary time. That's possible. It's not guaranteed. AI could cut in the very other direction. AI could make people much more productive and push in the other direction. I don't know, though. So, but you're right. But honestly, our focus is a much more practical one, and that is how do we keep inflation low and employment high in the near term. That's really what we're about.
Mark.
Hello, Chairman Powell. Mark Hamrick with Bankrate. What is the view about the growing amount of slack in the job market, including the softening in payrolls, the forecast of a modest rise in the unemployment rate, and the ability of workers to demand wage hikes or not in this environment where you have inflation surging?
You don't really see unemployment going up. You don't see increased slack, really. I mean, at the margin, remember, you're at 4.2% unemployment. That was, for many years, that was a extremely
Options
low
on
level.
SPY
It
calls
happens
right
to
now?
come up off of an even lower
I don't
level.
trade.
As we came out of the pandemic, we were
I
as
don't
low
trade
as
equity
3.4%.
options.
4.2%
Even if I
is
did, I
probably
don't give
at the
financial
low
advice.
end of
It's up to
estimates
you.
of the longer run, sustainable level of natural
I
rate of
also-
unemployment. So
I mean, it
wouldn't-
depends
guess I
on a
wouldn't
lot of
agree with
things.
that. And also, in terms of wages,
I'm a professional, vol trader,
real
though.
wages after inflation have been
I just
moving
don't
up
trade,
sort of more
equity vol.
than was consistent with 2% inflation. They're still moving up at a healthy clip.
I could
and
look at
think
a
much
trade
more
idea.
consistent with 2%
I've given
inflation,
my
given
opinions on trade ideas, but I can't
a
say if
reasonable
it's like
assessment of
financial advice.
trend productivity. So it's a pretty good labor market. You're right that the level of job creation has come down, but so has the supply of workers, the change in the supply, the new supply. So you've seen the unemployment rate remain pretty stable at 4.2. It's been as high as 4.3, but those are good numbers. So it's a pretty good labor market. There's a more concerning thing is There are not a lot of layoffs, but they're not.
Bigger question is, are you just punting calls because you just want upside leverage, or are you actually playing it like
very few people are being laid off
using
at
calls
this
as like a
point. So
fundamental
that's a
portfolio object?
equilibrium we watch very, very carefully, because if there were to be significant layoffs and the job finding rate were to remain this low, you would have an increase in unemployment fairly quickly. But that hasn't happened. It really hasn't happened. The U.S. economy has defied all kinds of forecasts for it to weaken, really, over the last 3 years. And it's been remarkable to see just again and again when people think it's going to weaken. Now, eventually it will, but we don't see signs of that now.
Go to Jean for the last question. Hi, Chair Powell. Jean Young with MNI Market News. There's been a lot of talk about cuts. I wanted to ask you, why do you think there are no forecasts for rates to rise or even to stay where they are next year, given that the projection for inflation is to rise to 3%, and there's a lot of there's some skepticism over whether those price hikes will be a one-time event?
So there are a number of people on the committee who wrote down no cuts this year, but some cuts next year. So, I think, people are writing down their most likely path, right? They're not saying there's zero possibility of other things. Really, think of it as the least unlikely path in a situation like this where uncertainty is very high. I think, again, people write down their rate paths, and they do not have like a really high conviction that this is exactly what's going to happen over the next 2 years. No one feels that way about their rate path. They feel like, what am I going to write down? I mean, what would you write down? It's not easy to
What do you mean, just lob calls on the high side?
I would just say it that way.
What's your
don't
delta?
Rule things in or out.
What's your tenor?
Certainly a hike is not the base case at all. It's not something people are writing down. But in the meantime, we do the best we can with these forecasts, and I think they're representative of the different forecasts.
I get you're newer, but these are like critical things that you need to know.
So thank you very much. Thanks.
This is The Fed Decides on Bloomberg Television and Radio.
Like,
Jerome Powell at the press
are you
conference
doing?
Central bank's decision to keep rates unchanged. What would you write down? I don't know. What would you write down? What about those dots? This is a Fed.
What are you doing? Blah, blah, blah. We'll do calls, strike. Can I center in by delta? I don't do equities, so.
Getting some clarity. There's still a lot to learn
Like
until
what?
the data becomes clear. They're on hold and are in a good place. Take a listen.
We feel like the right thing to do is to be where we are, where our policy stance is, and just learn more. And in particular, we feel like we're going to learn a great deal more over the summer on tariffs. We
want to do center strike
to show up much by now, and they haven't. And we will see whether, to the extent to which they do over coming months. And I think that's going to inform our thinking.
Jerome Powell also asked about the situation in the White House,
What?
dismissing questions around the future for
625?
him on the Federal Reserve.
I need to ask, assuming you are not reappointed, would you stay on as governor when your term as chair ends?
I'm not thinking about that. I'm thinking about this.
Is a retracement of some of the earlier
Like this would be a
moves we are
25
seeing,
delta.
bond yields actually climb back to basically where they were and then some.
This would be a 25 delta call. Would be
It seemed like this was a
629
Fed chair, so we are past peak uncertainty,
August
but we probably will have more
calls.
information
They're a
later
bit
to stop
expensive.
It's true the press conference looking at correlation of equities, bonds, currencies, commodities was sort of
15, 13 and a half vol.
I didn't get any real
You're paying
conviction.
3 cents a day on
But the
theta.
one tone
Half
I
decent
saw from
gamma.
what I hear in some conversations is what if we're underestimating the power of this American economy? There's a gloomy call. The GDP numbers
trying to
are
remember
down,
how-
inflation's up. Woe is me.
Option monitor.
But and that but was just
With
there
FX, it's a
for
completely
bit
different
where he
system
said,
on
"You
how
know
Bloomberg
what?
does it.
It is a resilient economy."
You have said the phrase that I think about all the
Well,
time.
oh, I
which
should have
is
just done
always
this.
adapt and
Strike,
adjust. And
25
we hear that
delta.
from so many companies that are doubling down on some of their forecasts.
not money
because-
there.
On tariffs.
Yes, exactly, because they have to look past that. And
I
they can
hate how
handle some of
Bloomberg
these
does options
tariffs. What I thought was
sometimes.
interesting was that this was a Fed chair. that
Strike. I
actually
can't just
said
do
if we were
25
backward
delta.
Looking at the data, we probably would be cutting
No,
more
25D.
quickly.
What did we
Because
say
of
it
the
was?
tariffs and the forward expectation for more inflation,
Right.
it does create a greater degree of uncertainty, which is
629.
the reason why we still are.
I gotta reload this
You don't
shit.
see this, folks, but Lisa during the press conference, she's got one of those little clicker things like in a movie theater, and every time they say uncertainty, you're moving your thumb around.
Can I do 25 delta?
150. Well, it's surveillance.
Ah, this is the minus
The issue
25.
here, Lisa, is the uncertainty issue was given to them. They didn't invent it. The president's comments today, outrageous comments. Do you see what he did to McKee? He slammed Michael McKee after those rude McKee-like questions. Tariffs, Bob Michael.
Oh, I can do delta up here. I'm a moron.
We have no clue.
Which is the reason why they aren't necessarily going to make any big moves
ba.
right now. Joining us now is Stephanie Roth of Wolf Research. So please
5
say,
delta, price and
that you're here in
percent. Blah, blah,
studio.
blah.
Stephanie, what was your take on a press conference where this Fed chair said that he had more certainty, but there'll be more later on?
I think the single.
You can just write it in
most
chat.
important thing he said is rates aren't very high.
Just give me
And
your
when we're thinking about the next couple
your
of months, we're gonna
trade
learn
your
more
settle
about
date
the
and
So then they're going to incorporate that fully into the SEP.
just
and
give
this
me
is
your
gonna
settle
lower
date and the strike. That's all I
In
need.
these cases this year, they're
I
not
can
cutting.
find it.
And the two cuts are going to eventually get sort of rolled away. At this point, they were very close on the edge of between 1 and 2, and they're probably going to
Like, let's look at
not end
this.
up cutting this year because the economy
This is just a
resilient
25
and
delta
fine,
upside call.
and inflation's elevated.
On the core GDP equation, do you have any conviction at all?
I'm not a big favor of just
I don't know how you
hunting
do it. I
topside
don't know how you
calls
come
though.
up with a
I really
real
don't put on a risk reversal.
Yeah, we're looking for 1.4% GDP this year, so not that different from the Fed. But I think
Also,
the
this
important
spot
thing
range
to focus on
is
for
fucking
2026,
ridiculous.
My forecasts are a lot
Should be
higher.
500 to like 700 points.
Something that's close to 2%, if not a bit above. Our forecast is that reconciliation bill could boost the economy by about 40 basis points. So that could be a notable
Break
acceleration
even.
versus where we are today. And that's what the market's going to start focusing on.
Lisa, help me. Is the reconciliation bill the big beautiful thing?
It's one big
Is that one
beautiful
part?
B.
Okay,
It's one
big.
3B. Yes, we can.
Again,
shorten
more
that.
uncertainty.
Well, that's the problem, and I really was struck by the idea that Fed Chair Powell brought to the fore, which is in response to Nick Timiraos of the Wall Street
Oh, no,
Journal
I hate
question, why
how
aren't
it does
you
this.
looking at some of the weakening trend that we're seeing in inflation and say, you know what, we're actually quite
I mean,
restrictive. Why are you saying that this is?
There are also better ways to just get long topside gamma.
Said, well, the
If that's what
reason
you're trying to
why is
go
because
and
we
do.
have to look forward, and we have to say.
I mean,
this could
the question you
potentially
always have
be
to
inflationary.
ask
We
yourself
don't
in
know, and we
options
will learn
is
more in the next couple of
what's
months.
what's
We're
the
not sure how
fundamental
much we're
goal
gonna
here?
learn.
If it's just to go and get topside exposure,
Does that ring true to you that
you can do it in several ways without just being hunting topside calls
They know that the tariffs
and
will be
getting
inflationary.
absolutely
Very much
cooked on your
emphasize someone
theta
will
every
pay
single
the
day.
cost, and eventually they're going to try to get it to the consumer. And I think that's the right way to think about it. It's going to
Call spread would be better.
Some portion of it to the consumer. Our numbers are similar to the
You can buy
Fed's
30.
forecast
You
that
can buy a
inflation should be
35
close
delta
to
call and
3%
sell
by the
a
end of this
15
year.
delta put. I mean,
And at this point,
13
we
delta
don't know
call.
that much. It's hard to forecast these things, but I think the main takeaway is inflation will be.
I deal in
elevated this
very,
year,
very
but Wall
large
Street probably will
structural
perform
option
just fine.
positions.
Which
So
is essentially what they were
it's very,
saying,
very different.
albeit at a slower pace. Right now, we're so lucky to have Torsten Slok of Apollo joining us. Torsten, thank you so much for being here. What was your take on the press conference, on the Fed stance, and frankly,
Chat,
the
what do we
market
think?
taking
What did we think of this press
just in
conference?
stride, not saying that they're getting much new information here.
What do we think of the Fed press conference? I'm actually surprised how much, how hawkish the market.
Down GDP growth to 1.4, and they revised up inflation to 3%. That's telling you that they are beginning to worry about the things that are hitting the U.S. economy, and it's no longer just trade and tariffs that's stagflationary. Oil prices are also stagflationary, meaning higher inflation, lower GDP growth. And restrictions on immigration is also stagflationary. We already saw in the last employment report upward pressure on wages, and of course that ultimately means downward pressure on employment if we're going to do, in particular, deportations at the current pace. So the conclusion is, it is not surprising that the Fed is beginning to worry about their mandate being torn in the opposite direction, because inflation
You did a
higher
same
says
day
they should be
option.
hiking. GDP growth lower says they should be cutting. So that's why at the moment they stay put. And the conclusion, therefore, is that he didn't really give much other than say we will likely be cutting, and that's what's in the
Is this
dot
a
plot.
0
But
day
the
option?
conclusion is this is a very difficult situation for them when there's both, as he said,
Because it
meaningful
says it's
expectations of
a
upward pressure on inflation,
June
at the same
18th, which
time,
is
a
today.
revision down in GDP growth.
Torsten, he alluded to a data capture, which is perhaps showing a more resilient GDP, a
606.
better, stronger America. Steve Raschuta at Mizuho is heated about
Yeah,
this.
0 day options
We
are
see
for
GDP better.
chuckleheads,
Is it in any
especially if you don't
probability
understand options.
Well, I think that when it comes to a particular trade, forgive the picture here, but the pig
It's a
is coming
70.
through the
It's
pipe,
a
which is
48
always
delta.
the tax increase on imports. Tariffs have gone up, and if companies are not passing this on to consumers, let's say that inflation does not go up as much as we would have expected, then the conclusion is, well, then earnings will simply be going down more because this tax increase.
I mean,
means,
what?
of
How much
course, that we
premium
will
did you?
begin
How
to
much
see
premium is
some
this?
downward pressure on GDP and potentially some more downward pressure on earnings. So that's another way of saying we saw effective tariff rates go up from 3% in January to now 18% today, and that
Yeah, you're
will
getting
still be
cooked on
playing
your
out. And
theta.
he said very clearly he does expect a meaningful increase in inflation over the coming months. So combining
If you would have
that
done
with
this
what he said, we
before, you
also
might have
see
gotten
clearly
a.
out in the labor market,
It depends on when you
does
did
mean
it,
just maybe
but
inflation will not go up so much.
these are going to
The
expire
consequence of that will be,
worthless.
well, then we will instead see tariffs coming through instead
You're just paying
through
premium.
lower GDP growth and a bigger hit to earnings.
You're paying premium, and you're giving the market maker, whoever sold this to you, a ton of free theta.
If you are just joining us,
Yeah,
we
they
just
got short
concluded
gamma,
the
but it
Fed's
actually
press
worked
conference.
kind of
Looked
well
like
for them.
You put him on the spot there with the political question. I don't know that he loved answering it. We were all glad that you
That's
asked it.
why
What was your takeaway
market makers,
from
especially
the
for
press
zero
conference in
DTE,
terms of what you felt
love people
was
like that.
the most new information that we gleaned?
Hell yeah, I'll sell you as many topside calls as you want right now that expire in right now 30 minutes. I'll take in a couple grand of theta a day from you.
Look at is how many times Jay Powell said nobody on the committee has a lot of conviction about these forecasts. In other words, this is all going to
For
change,
sure, I'd trade.
and we had to write down
I'd
something, so
trade
we
this
did.
against you. I'd take the other
So
side of this.
Don't take us seriously in terms of the number of rate cuts. Don't take us seriously in terms of the forecast. It's the best we can do at the
Can I go and
moment,
see the
but we
Greek
know
overlay
this
on
is all
this?
going to be different. So don't. I would translate that into don't invest.
I can't even really
on
do
the
that much
idea that
zero
the Fed is
DTE because
doing
it all
rate
does the
cuts by
maturity
end of the year.
steps in
Michael McKee,
months.
thank you so much for being with us. And Stephanie, we were kind of laughing around the table when he said, we just kind of turn to each other and say, what did you write down? You know, I don't know. I'm kind of throwing a dart at the dartboard, but it does feel like they are trying to message something to markets.
I mean, they got a little bit
Do you
short
think that
gamma,
this
but
is
they're probably
saying,
taking in a lot more
ultimately, we
theta.
understand our dual mandate, and we are going to respond potentially to a weaker jobs picture?
I think it's saying.
But yeah, it's an easy sell.
There are risks to both sides of our mandate.
If
We
you're a
don't
market
know
maker.
if it's going to be on the inflation or the growth side, and at this point we're in wait and see mode. I think the ultimate destination will be that the economy.
Any other
is
option
okay.
questions while I'm
If
still here?
inflation does pick up. I totally agree with Torsten's comments. If it doesn't pick up, that's almost a bad sign because that's going to come from company margins. But at the end of the day, we'll come through this okay, and then the focus will be on 2026 for markets, which is an economy that's just fine.
Your core abilities.
That's one thing that you should never do if you ever want to get into options is play in something as stupid as zero DTEs.
Is there a total factor productivity right now that we underestimate?
Yeah, I think that's certainly the case, and hopefully it's the case, especially given that.
No one's gonna sell. No one's gonna buy this back from you.
That to some extent. And
It's
I
gonna
think
expire
that
worthless.
Productivity should be fairly solid throughout the course of this year into next year. It is hard to estimate, but I do think AI is going to slowly have that impact over the course of.
I mean, you bought it for $1. The market value is zero.
You've been really good on this.
You
We're
spend
not
$1, you
selling
lost $1. That's
inflation. A lot
options.
of people say that's not their base case, but we are going to get a slowdown at a time of increasing inflation.
And you
People
probably,
seem to think if
when
the
you
recession
bought
is
it,
really
it
bad, if
probably
there's not a
was,
recession,
yeah,
that's really
last
good.
price 0,
What
average
is
price
that breaking
0.01.
point
They
where you
put a
have
spread on it
growth
because they know it's going to
slowing
expire
enough
worthless.
that it becomes really terrible for companies in terms of
This is
where
why you don't
inflation
do zero
is and
DTE
just
options.
not keeping up.
The reason why they're there is one, to go and capture people like that are new into options because they have no idea what they're doing. It is way better to go and like do one call on the S&P, like the SPY versus doing zero DTEs. They're cheap, I understand that, but they're cheap for a reason. They're meant to go and hedge your intraday exposure if you have big positions. It's one thing to go and say, okay, I'm going to go and buy a zero DTE put on SPY. Because it's one thing to go and say, okay, I'm going to go and buy like a 25 delta zero DTE put that's like down here when you're coming into Fed day and you're long to go and hedge your position. It's different than making that your entire position. Zero DTEs are meant to go and reduce intraday volatility in pretty big equity positions. you're talking typically hedge funds. The reason why retail gets into it is because they cost like a couple pennies, and they know they're stupid enough to go and trade them a bunch, because all they go and see is the gamma, meaning how much you get paid based off of the change in price. Well, technically the change in delta, so how much variability there is massive, because there is zero DTE, and gamma is always the biggest on the time of expiration. So they're always going to be super high gamma. You pay a lot in theta, which is the inverse of gamma. And people are playing them because they have super high deltas. Delta, of course, is the options movement per 1% change in the underlying. So for something like this, where it's 47 delta, I mean, it's going to move a lot because it's practically an in the money call. Meanwhile, you're going to get whipped around by your gamma, and you did, because
thank you so much for being with us and for
you had a big move.
Joining us now is Subhadra Rajappa of SocGen. Just curious, Subhadra, what you make of this idea that rates.
Meanwhile, the market maker on the other side's like, sure did. I'll go and get paid by holding some of this risk.
Causing the restraint that many people would expect. Do you think that this was an appropriate Fed meeting?
You know, let's call a spade a spade. I must say I didn't get a lot of new information out of this meeting. I think Mike Mickey summed it up. There's a lot of uncertainty. The first half of the year, the economy's been extraordinarily resilient. There's a chance that we get higher inflation.
Any other option questions?
There's a chance that the growth could slow down as well. But that doesn't really give us a lot of information on exactly what they're going to do on the policy front. Yes, the dots are showing 2 cuts for this year, but there's a good chance that they don't cut at all this year, or they have to cut as early as the September meeting if the data deteriorates. So for me, the informational value was very little. I think that there's a lot of uncertainty, which was highlighted again and again during the press conference, and I think that they're going to wait till they have enough information to confirm a rate cut. So
any other option questions, guys? If not, I'm going to head out.
The bond market really hasn't reacted much, so we need more information.
Subhadra, is the information going to come in the yield curve? We had a really informed question come in about the vanilla 2-10 spread. I'll let you pick the spread that matters. Are we going to go back to yield curve steepness as we saw many years ago?
Yeah, the 530s part of the yield curve has been steepening. The Fed, the front end is pegged to policy, so the 2 years is kind of stuck between 3.75 and 4%. And the 530s part of the yield curve has the potential to steepen. But again, a lot depends on what we get out of that big, beautiful bill. If it is actually more deficit inducing than what we are anticipating, then there's a potential that we could see a rebuild in term premia. But, those negotiations are still ongoing. And really, it's the fiscal side that determines what the shape of the yield curve is, not so much how much the Fed is going to cut, because cuts between now and the middle of next year are quite modest. We're looking at maybe 75 to 100 basis points of cuts at the most.
Stephanie, where are you on the fiscal space? I mean, I think this is, Bob Michael brought it up and others before, but this is a huge mystery that's unspoken. We don't have a clue where our debt and deficit is, do we? We have no clue.
We have one clue, and that's not good. So it's not heading in a very good direction. We all know that, but I think the bond market.
All right, chat, any option questions? Or should I head out? Fed meeting's done. Surprisingly, the market took it as pretty hawkish, even though Jerome pretty much said we're still on the wait and see approach, which I still don't understand why the market reacted the way it did, but very interesting. Dollar a little bit off the highs, but rallied. I mean, euro went negative, sterling went negative, equities barely holding positive, rates higher. I'm checking out the FX vol right now, because this move right here in the one by the euro risk reversals is actually massive. I'm surprised it moved that much. Meanwhile, vol collapsed in most. I mean, you rolled through an event, but still. Vol should be shouldn't have come off of this much, especially in the 1 month for the euro. But yeah, if we don't have any more option questions, I'm going to go and end it here, boys. Give you guys like a couple minutes in case you want to formulate a question.
The headline, which is this is the first statement of economic projections post the tariff uncertainty. And mostly he got away with not really talking about that. Torsten just highlighted it a second ago. It's stagflationary. I don't think anybody raised that once that word ever came up. So we really kind of pivoted away from what might have been kind of an interesting storyline to the storyline that we're hearing, which is watching paint dry. And I think that's an excellent outcome for the Fed. That's what they want us to talk about, paint drying, and not the Fed opining on the impact of policy. They really ended up pivoting the conversation towards a repeat of nothing to see here, and we don't know, and it's much more about the uncertainty than it is about the forecast that we just wrote down. I think that's kind of an interesting takeaway. I think, as your previous guest just highlighted, that is the takeaway that the markets are having from today. And when you listen to the opening press conferences, I pull up last month's press conference, and you can follow along. It's
all right, chat. Last call on options questions, or I'm gonna head out. I've got a dinner tonight,
and maybe
and I got to travel for it. So,
for more information as opposed to waiting for
or any comments on the FOMC rate decision.
Jeff Rosenberg, when you look at what the president said on the lawn today, we're benumbed by presidential criticism of Jerome Powell. Is this a Fed, as we're all half asleep in a snooze fest, representing the haves in the financial industry? Or are they actually representing a good part of America that does not agree with this dialogue and says they're flat on their backs right now?
There are a lot of questions in there, Tom, for me to avoid answering. So I'm going to do my best imitation of Powell to pivot to answering it the way he answered Mike McKee's question, and basically restating what he wanted to answer, which is they believe they're following the right path. They are answering the right questions. They're pursuing the policy for the benefit of the economy overall that benefits the most of
all right, chat. No option questions, no econ debate. So I will end the stream here. Thank you guys so much for watching. I'm probably not going to be able to do one of these for a while. So, yeah.